The world is not safe. It never was. Look around you. Do you remember that frantic, sickening moment when the market suddenly became a sheer vertical cliff? When the headlines screamed collapse and your carefully constructed portfolio felt like sand slipping through your fingers. The dizzying terror of watching your future, the house, the retirement, the freedom, dissolve into thin air. You tell yourself, this is a once-in-a-generation event. You tell yourself, this is an anomaly. But what if it wasn't? What if every single thing you built, your strategy, your portfolio, your very outlook on life, was designed to break at the worst possible time? What if the system, the economy, and the global financial machine are not just fragile, but built with a terrifying, hidden design flaw, a flaw that only reveals itself when the earth shifts beneath your feet? You see the hype. You see the charts going parabolic. It's the FOMO, the fear of missing out, that gnaws at your gut. The neighbor bragging about their meme stock gains. The stranger on social media flashing their absurd profits from crypto hype cycles. You feel the pressure to chase the vertical green line, to put everything on a line just to catch up. And when you finally jump in, a silent, invisible mechanism starts to tick. You have unknowingly placed yourself directly in the path of a Black Swan, a high-impact, low-probability event that no one saw coming until it was already too late. This feeling, this frantic dance between greed and panic, is a symptom of profound and fundamental ignorance about risk. An ignorance that Nassim Nicholas Taleb spent his life exposing. And in the financial coliseum of the 2020s, where the Robinhood generation wields leverage like a digital sword, where financial influencers dispense complex advice in 60-second sound bites, and where the promise of early retirement to the FIRE movement drives people into increasingly precarious gambles. Taleb's ultimate work is no longer just a philosophy. It is a vital, urgent survival manual. This is the story of a hidden property of things, a quality that stands beyond mere resilience and robustness. It is the quality of things that not only endure chaos, but actually thrive on it. This is the antidote to fragility. This is Antifragile, the man who battled uncertainty, Nassim Nicholas Taleb. To understand the book, we must first understand the mind that forged it. Nassim Nicholas Taleb is not your typical academic or market commentator. He is a blend of a skeptical philosopher, a hard-nosed derivatives trader, and a classicist, born in Lebanon. The experience of witnessing the fragility and sudden collapse of a stable society gave him a visceral, non-academic understanding of radical uncertainty. He didn't just study chaos. He lived it. Taleb spent 2 decades as a quantitative trader, dealing with the esoteric and highly volatile world of options and derivatives. He was not a traditional forecaster. He was a risk professional who understood that the biggest threats do not come from the expected fluctuations, but from the sudden, unprecedented, and catastrophic shifts. He didn't focus on predicting the future, but on surviving, and even profiting from its unpredictability. His seminal work, The Black Swan, The Impact of the Highly Improbable, published in 2007, was a staggering intellectual achievement that became the unexpected soundtrack to the 2008 financial crisis. That book introduced the idea that the major events that shape history and markets, the internet, 9/11, the global financial collapse, are almost always unpredictable, retrospective, and profoundly consequential. The book became famous for showing what breaks in a chaotic world. Antifragile, published in 2012, is a logical and necessary successor to the Black Swan. If the Black Swan identified the problem, the massive blind spots created by rare, high-impact events, Antifragile offers a solution. It is a constructive philosophy, a toolkit for life and finance that moves beyond mere protection and into active advantage. Taleb's work is driven by a deep distrust of what he calls the intellectual yet idiot DIY. The highly credentialed experts, economists, and forecasters who rely solely on sanitized models and theories, while ignoring real-world skin-in-the-game consequences. His writing is often provocative, confrontational, and deeply learned, weaving together history, probability, personal experience, and classical literature. This isn't just a finance book. It's an education on how to live in a world defined by randomness. The third category, beyond robustness. The central thesis of Antifragile is a discovery of a third category of things. Think about the classic, simple dichotomy, When something is exposed to stress, chaos, or volatility, it is either fragile or robust. Fragile, a wine glass. When you drop it, it breaks. It is harmed by disorder. Robust, or resilient, a steel cube. When you drop it, it remains the same. It resists damage. It tolerates disorder. Taleb realized that this dichotomy is incomplete, and crucially, it is precisely this incompleteness that led to massive systemic failures in finance and governance. There must be a property for things that actually benefit from shocks, things that get better when exposed to stress, volatility, error, and attack. He coined the term antifragile. Antifragile is not merely robust. The robust resists, the antifragile improves. A robust system stays the same, using energy to maintain its state. An antifragile system uses the energy of the shock itself to leap forward. Example 1. The human body. When you lift heavy weights, your muscle fibers tear. This stress, a shock, a volatility event, does not kill the muscle. It triggers a mechanism that repairs the fibers to be slightly thicker and stronger than before. Your body is antifragile to physical stress. Example 2. Evolution. Species do not survive because they are robust to changes in the environment. They survive because errors, mutations, and sudden environmental shocks force adaptation, leading to superior new forms. Biological systems are antifragile. Example 3. Financial option strategy. A complex financial option that costs a small amount but pays out massively, exponentially, if a market crash, a rare shock, occurs. It is designed to benefit from extreme market volatility. This concept shifts the entire focus from prediction to preparation. If you cannot predict the future, the goal should be to position yourself, your career, your life, and most urgently, your portfolio, so that when the unpredictable happens, everyone else is breaking and you are gaining. Antifragile in today's volatile financial world. Why is Antifragile the most important book you can read right now? Because the financial landscape of the 2020s is a testament to the sheer, catastrophic failure of fragile systems. 1. The meme stock and crypto hype cycles. The rise of the meme stock phenomenon, GME, AMC, and the insane volatility of crypto hype cycles are not just isolated stories of retail enthusiasm. They are the ultimate expression of anti-fragility and fragility colliding. The fragile investor. The vast majority of people who bought the stocks or coins near the peak were fragile. They were exposed to enormous potential upside, but an even greater potential downside. Their strategy relied on the continuation of a non-linear, unsustainable trend. When the shock came, a sharp pullback, they broke, suffering massive losses. The anti-fragile structure. The companies themselves, the platforms, and the handful of investors who were shorting or had complex option strategies were anti-fragile. The brokers and exchanges benefited hugely from a massive volume and volatility, generating unprecedented fees. The chaos was profitable for the structure, even if it destroyed the individual. This is a core Talebian insight. Fragility is often transferred to the unsuspecting. The system's chaos becomes your profit or your destruction. 2. The Robinhood generation and leverage addiction. The advent of zero-commission trading and easily accessible leverage on platforms like Robinhood has created a generation of amateur investors playing a professional's game. This creates massive fragility. Leverage, trading on margin or using derivatives, is the ultimate fragility amplifier. It allows small shocks to turn into total ruin. It is structurally designed to guarantee that when the inevitable big shock arrives, you will be wiped out entirely. The seduction of the easy win. This culture encourages frequent high-risk betting, mistaking luck for skill, a classic Talebian danger. The smooth user interface, the confetti on a trade, and the constant digital feedback loop amplify both greed and, eventually, panic. Taleb would see this as a perfect storm. Complexity, derivatives, leverage, paired with lack of skin in the game. It's not the platform's money being risked, and complete ignorance of tail risk, Black Swans. 3. The FIRE movement and financial influencers. The FIRE movement, financial independence, retire early, is philosophically robust. Save aggressively, invest passively. However, its modern, aggressive strain often pushes people into hyper-risky asset allocation, desperately trying to shave years off the timeline. This fragile element, betting on a continuous bull market or unsustainable high-yield strategies turns a sensible philosophy into a high-stakes gamble. Meanwhile, financial influencers proliferate, offering simplified, often overconfident advice. Taleb detests the overconfidence of experts without real-world consequences. The influencer has everything to gain: followers, money, fame, and nothing to lose. Their advice costs them nothing if it's wrong. They have no skin in the game, a hallmark of a fragile system built on misleading authority. 4. Trading psychology, chaos, and the path to calmness. The greatest enemy of the modern investor is not the market, but the amplification of greed and fear through digital media. The non-stop news cycle, the Reddit panic, the financial TikTok videos. They create a constant environment of noise and stress, which is poison for decision-making. Antifragile offers a profound psychological bomb. It teaches you that since you cannot control the chaos, you must control your exposure to it. The goal is not to eliminate risk, but to make sure that the vast majority of possible outcomes, the small, frequent fluctuations, do no harm, while the small minority of extreme outcomes, the Black Swans, actively help you. This is a path to calmness, to emotional discipline. By building antifragility into your life and portfolio, you reduce the tyranny of prediction and the anguish of market panic. You stop playing a fragile game you are destined to lose, and start building a structure that feeds on chaos. Over the course of this breakdown, we will explore the core architecture of this idea, from the difference between the tour of symmetry and the domain of extremism to the lessons of the Barbell Strategy, and how to identify and avoid the Fragilista, the person or institution actively making things more fragile. Prepare to look into the nature of risk, prediction, and human error with unprecedented clarity. The journey begins now. We will learn how to make disorder your most powerful ally. This is the script for Chapter 1, wherein we introduce the concept of antifragility, significantly expanded and detailed to meet your length and style requirements. Chapter 1, wherein we introduce the concept of antifragility. The journey into antifragility begins with fundamental recognition. The world is not merely divided into things that break and things that don't. That simple, binary categorization, fragile or robust, is the intellectual flaw that leads to systemic collapse and personal financial ruin. It is the flaw that the modern world, obsessed with optimization and smoothing out every bump, desperately tries to ignore. Nassim Taleb forces us to confront this blind spot by identifying a third category, the thing that has no single elegant word in any modern language. This third category is the key to mastering uncertainty. Imagine a delivery service. You can send a package marked fragile, meaning handle with care, a shock will harm me. Then you have a steel vault, which you might implicitly mark robust, meaning I don't need care, a shock won't harm me, but it won't help me either. But what if you could mark a package antifragile? That sticker would read, please mishandle, please expose to stress, please drop me. By all means, send me through the worst possible turbulence, because that is how I improve. This is the concept's profound, almost paradoxical power. Antifragility is defined as a nonlinear response to stressors, while fragile systems like a highly leveraged hedge fund or a delicate supply chain exhibit downside asymmetry, meaning the harm from a bad event is exponentially larger than the benefit from a good event. Antifragile systems exhibit upside asymmetry. For an antifragile entity, the potential gain from a positive shock is massively, non-linearly greater than potential loss from a negative shock. It is this payoff asymmetry that changes everything about how we build our portfolios and how we live our lives. The muscle fiber we tear at the gym, which repairs itself stronger than before, is antifragile. The Greek mythical creature, the Hydra, which grew 2 heads for every one that was chopped off, is antifragile. The most powerful example in the financial world is the simple, honest option, the right but not the obligation, to buy or sell an asset. When you pay a small fixed premium for an option, your maximum loss is capped at that premium, a small, known, fragile cost. But your maximum gain is theoretically unlimited, an antifragile potential. This asymmetry, small, constant losses but massive, occasional gains, is the architectural blueprint of an antifragile strategy. The essential takeaway from this introductory chapter is that volatility, randomness, uncertainty, and disorder are not enemies to be avoided. They are fuel. They contain information. They trigger necessary adjustments, and they present opportunities for nonlinear, exponential payoffs. The robust system expends energy to stay the same. The anti-fragile system uses the energy of the chaos itself to evolve and leap forward at the anti-fragile structure. The companies themselves, the platforms, and a handful of investors who were shorting or had complex option strategies were anti-fragile. The brokers and exchanges benefited hugely from a massive volume and volatility, generating unprecedented fees. The chaos was profitable for the structure, even if it destroyed the individual. This is a core Talebian insight. Fragility is often transferred to the unsuspecting. The system's chaos becomes your profit or your destruction. 2. The Robinhood generation and leverage addiction. The advent of zero-commission trading and easily accessible leverage on platforms like Robinhood has created a generation of amateur investors playing a professional's game. This creates massive fragility. Leverage, trading on margin or using derivatives, is the ultimate fragility amplifier. It allows small shocks to turn into total ruin. It is structurally designed to guarantee that when the inevitable big shock arrives, you will be wiped out entirely. The seduction of the easy win. This culture encourages frequent, high-risk betting, mistaking luck for skill, a classic Talebian danger. The smooth user interface, the confetti on a trade, and the constant digital feedback loop amplify both greed and, eventually, panic. Taleb would see this as a perfect storm. Complexity, derivatives, leverage, paired with lack of skin in the game. It's not the platform's money being risked, and complete ignorance of tail risk, Black Swans. 3. The FIRE movement and financial influencers. The FIRE movement, financial independence, retire early, is philosophically robust. Save aggressively, invest passively. However, its modern, aggressive strain often pushes people into hyper-risky asset allocation, desperately trying to shave years off the timeline. This fragile element, betting on a continuous bull market or unsustainable high-yield strategies, turns a sensible philosophy into a high-stakes gamble. Meanwhile, financial influencers proliferate, offering simplified, often overconfident advice. Taleb detests the overconfidence of experts without real-world consequences. The influencer has everything to gain, followers, money, fame, and nothing to lose. Their advice costs them nothing if it's wrong. They have no skin in the game, a hallmark of a fragile system built on misleading authority. 4. Trading psychology, chaos, and the path to calmness. The greatest enemy of the modern investor is not the market, but the amplification of greed and fear through digital media. The non-stop news cycle, the Reddit panic, the financial TikTok videos, they create a constant environment of noise and stress, which is poison for decision-making. Antifragile offers a profound psychological bomb. It teaches you that since you cannot control the chaos, you must control your exposure to it. The goal is not to eliminate risk, but to make sure that the vast majority of possible outcomes, the small, frequent fluctuations, do no harm, while the small minority of extreme outcomes, the Black Swans, actively help you. This is a path to calmness, to emotional discipline. By building anti-fragility into your life and portfolio, you reduce the tyranny of prediction and the anguish of market panic. You stop playing a fragile game you are destined to lose, and start building a structure that feeds on chaos. Over the course of this breakdown, we will explore the core architecture of this idea, from the difference between the Torah symmetry and the domain of extremism, to the lessons of the Barbell Strategy, and how to identify and avoid the Fragilista, the person or institution actively making things more fragile. Prepare to look into the nature of risk, prediction, and human error with unprecedented clarity. The journey begins now. We will learn how to make disorder your most powerful ally. This is the script for Chapter 1, wherein we introduce the concept of anti-fragility, significantly expanded and detailed to meet your length and style requirements. Chapter 1, wherein we introduce the concept of anti-fragility. The journey into anti-fragility begins with a fundamental recognition. The world is not merely divided into things that break and things that don't. That simple, binary categorization, fragile or robust, is the intellectual flaw that leads to systemic collapse and personal financial ruin. It is a flaw that the modern world, obsessed with optimization and smoothing out every bump, desperately tries to ignore. Nassim Taleb forces us to confront this blind spot by identifying a third category, the thing that has no single elegant word in any modern language. This third category is the key to mastering uncertainty. Imagine a delivery service. You can send a package marked fragile, meaning handle with care, a shock will harm me. Then you have a steel vault, which you might implicitly mark robust, meaning I don't need care, a shock won't harm me, but won't help me either. But what if you could mark a package antifragile? That sticker would read, please mishandle, please expose to stress, please drop me. By all means, send me through the worst possible turbulence, because that is how I improve. This is a concept profound, almost paradoxical power. Antifragility is defined as a nonlinear response to stressors, while fragile systems like a highly leveraged hedge fund or a delicate supply chain exhibit downside asymmetry, meaning the harm from a bad event is exponentially larger than the benefit from a good event. Antifragile systems exhibit upside asymmetry. For an antifragile entity, the potential gain from a positive shock is massively, nonlinearly greater than the potential loss from a negative shock. It is this payoff asymmetry that changes everything about how we build our portfolios and how we live our lives. The muscle fiber we tear at the gym, which repairs itself stronger than before, is antifragile. The Greek mythical creature, the Hydra, which grew 2 heads for everyone that was chopped off, is antifragile. The most powerful example in the financial world is the simple, honest option, the right, but not the obligation, to buy or sell an asset. When you pay a small fixed premium for an option, your maximum loss is capped at that premium, a small known fragile cost. But your maximum gain is theoretically unlimited, an antifragile potential. This asymmetry, small, constant losses but massive, occasional gains, is the architectural blueprint of an antifragile strategy. The essential takeaway from this introductory chapter is that volatility, randomness, uncertainty, and disorder are not enemies to be avoided. They are fuel. They contain information. They trigger necessary adjustments, and they present opportunities for nonlinear, exponential payoffs. The robust system expends energy to stay the same. The antifragile system uses the energy of the chaos itself to evolve and leap forward. Crucially, Taleb highlights the danger of the Fragilista, the person who believes they can simplify, optimize, and eliminate randomness from complex systems, often under the guise of increasing efficiency or safety. These well-meaning or perhaps self-interested interveners, who often lack skin in the game, create massive, hidden vulnerabilities by suppressing natural, smaller variations and volatility. By preventing a system from having small, necessary failures, the Fragilista ensures that when failure finally occurs, it is total and catastrophic. This is the difference between letting a fire burn naturally in a forest, which clears out brush and prevents a massive blaze, and suppressing every small fire until the entire ecosystem is primed for a super catastrophe. The fragility is merely transferred and amplified, waiting for the inevitable Black Swan event. Modern investing reflection. The introduction of antifragility is the most potent lens through which to view the last decade of financial mania, specifically the Bitcoin bubbles and the Tesla hype. Consider early investors who bought Bitcoin or high-risk technology stocks like Tesla a decade ago. Did they predict the market cap would reach hundreds of billions? No. They simply took small, measured bets on an unknown technology or a disruptive founder. Their initial capital was fragile. They could lose 100% of the bet. But their overall exposure was structured to be anti-fragile. They made many small bets, many of which, like other failed crypto projects or startups, went to zero, a small necessary loss. But the one or two that succeeded, Bitcoin, Tesla, provided an exponential, non-linear return that covered all the losses and delivered generational wealth. The volatility of the asset itself was the engine for their gains, punishing latecomers and rewarding those who simply exposed themselves to potential upside without risking total ruin. Contrast this with the prevalent modern practice of leverage addiction amplified by zero-commission trading. When retail traders use massive margin loans to buy mainstream index funds, they believe they are being robust because they are buying safe assets. But by applying leverage, a fragility amplifier, they have transformed a robust asset, a diversified index, into an acutely fragile position. A simple 20% market drop, which is normal volatility, can wipe out a 5 to 1 leverage account, turning a temporary setback into a total, irreversible loss. The system is rigged for this. The small, frequent returns go to the investor, but the rare, catastrophic volatility event triggers a margin call that transfers all the capital to brokerage or the bank. Taleb's lesson here is clear. The goal is not high returns. The goal is structural survival combined with optionality. Optionality is the right to engage in a favorable future scenario without the obligation to engage in an unfavorable one. Early Bitcoin was a huge option. Buying an actively managed ETF built around predicting every move is a fragile exercise in forecasting. The modern investor must stop trying to predict the small movements and instead focus their energy on building a portfolio that has everything to gain and very little to lose from the chaos that will inevitably come. The true anti-fragile strategy is to survive the social media financial panic cycles with your core capital intact, while holding small, intelligently placed seeds that require chaos and disruption to grow into trees. Chapter 2 of the difference between negative and subtractive. The modern obsession is with more data, more interventions, more efficiency, more optimization. When we face a problem, our instinctive, deeply ingrained solution is almost always additive. We look for a pill to take, a regulation to impose, a complex algorithm to deploy. We believe that progress is measured by what we put into the world. But in this chapter, Taleb dismantles this fundamental bias, revealing one of the most powerful and counterintuitive pathways to antifragility: the therapeutic, purifying power of subtraction. Taleb introduces the philosophical concept of via negativa, the path of the negative. It is a deep wisdom found across ancient traditions, from Stoic philosophy to practical medicine, which suggests that we often achieve improvement not by adding, but by taking away. Instead of searching frantically for a complex truth, we should focus on robustly identifying and eliminating known falsehoods, errors, and harms. This is the difference between something that is negative, a harmful addition to a system, and something that is subtractive, the beneficial removal of that harm. Consider the human body, the most profound example of an anti-fragile system. When you feel unwell, the first and often most effective cure is not a complex, newly synthesized chemical, which is an additive intervention with unknown, long-term side effects. Instead, it is usually rest, the removal of stress, the subtraction of junk food, or the elimination of a toxic habit. The problem with many modern solutions is that they confuse the map for the territory, prioritizing laboratory-perfected additives over the body's innate, time-tested wisdom. Taleb argues that it is far easier to know what is wrong for you than to know what is perfect for you. By removing the known wrong, you allow the anti-fragile, self-healing properties of the system, your body, your portfolio, your life, to take over. This lesson translates devastatingly well to financial and political systems. The Fragilista, the self-styled expert, constantly seeks to intervene. They see a fluctuating economy and immediately propose a new layer of complex regulation in addition, often based on flawed models. They see market volatility and suggest a sophisticated new hedging instrument, another addition. Each intervention, each new layer of complexity, adds points of unknown, highly concentrated fragility. These systems become like intricate houses of cards. They appear hyper-efficient and optimized for normal conditions, but a single, slight tremor can bring the entire edifice down. The true anti-fragile solution is often subtractive. In ancient times, the medical code of conduct was primum non nocere. First, do no harm. Taleb extends this to all complex systems. If you cannot prove that your intervention will not cause systemic harm, the via negativa suggests that a default action should be non-intervention. The best financial planner is often the one who persuades a client to remove high-interest debt, remove behavioral biases, and remove unnecessary transaction costs. These are subtractive benefits that are robust and virtually guaranteed. They are not dependent on prediction. They are dependent on the simple, powerful act of simplifying. The key is realizing that most of the benefit in any domain, be it health, wealth, or knowledge, comes from the elimination of the bad, which is often easier to identify and has less risky side effects than the introduction of the supposedly good. We are often better off with no doctor than a bad doctor, no politician than a bad one, and certainly no financial advisor than one who actively adds fragility to our future. Modern investing reflection. The rise of ETF dominance and the passive versus active investing debate is the financial world's perfect illustration of the power of via negativa. For decades, the standard path involved additive financial activity, hiring an expensive active fund manager, constantly reading analyst reports, trading in and out of stocks based on forecasts, and trying to time the market. This entire structure is fragile. It relies on the addition of human skill and complex analysis. The fund manager must be right year after year. The research must be predictive, and the transaction costs, a form of friction and negative complexity, must be constantly overcome. These additions, statistically speaking, have been shown to make most investors worse off. The passive investing revolution, epitomized by the index fund and the massive inflow into ETFs, is fundamentally a subtractive strategy. It is the ultimate exercise in via negativa applied to finance. What does it remove? It removes human error and ego, the temptation to buy high and sell low. That removes high management fees, a constant negative drag on returns. That it removes the need for prediction and forecasting, the hallmark of fragility. By simply subtracting the unnecessary and often harmful friction of active management, the passive index fund allows the inherent, anti-fragile property of the capitalist economy, its natural, long-term upward drift, to work unimpeded. The strategy doesn't try to add a marginal gain. It simply ensures that you are not losing a guaranteed portion of your capital and psychological energy through foolish, active intervention. It is a robust, simple approach that, over time, benefits from the volatility of the market without being destroyed by it, because it has removed the primary fragility amplifier, the overconfident human agent. This also ties directly to the addiction to leverage and option gambling in the 2020s. The day trader on a digital platform is constantly trying to add leverage, a fragility booster, or add complex option strategies, a path for small errors to become massive losses. The truly anti-fragile trader, by contrast, practices extreme subtraction. They remove leverage entirely, remove the speculative hot stocks, and remove the digital noise of social media financial panic cycles. They may choose to keep a small, isolated barbell of high-risk, high-optionality bets, but their core capital is protected by the elegant, powerful simplicity of via negativa. Do nothing, keep it simple, and remove the things that are known to kill you. The greatest gain, this chapter reveals, is often found in the silence left by the things you've chosen to eliminate. Chapter 3, The Cat and the Washing Machine. This chapter introduces one of Taleb's most enduring and accessible metaphors, forcing us to recognize the profound difference between the resilience of the natural world and the brittle fragility of the manufactured world. Pitting the cat against the washing machine, Taleb lays bare the systemic vulnerabilities we create when we replace simple, time-tested evolutionary design with complex, optimized human engineering. The washing machine represents the modern engineered, hyper-efficient, and, crucially, fragile system. It is built to perform a specific, predictable task under specific, predictable conditions. Every single part is necessary, and its functions are intertwined in a perfect, complex choreography. If one small component, a cheap plastic gear, a single wire, or a line of code in an internal computer, breaks, the entire machine ceases to function. The failure is global. It is an all-or-nothing breakdown driven by a single point of failure. These engineered systems, from modern aviation to complex algorithmic trading engines, are optimized to the nth degree, but in that optimization lies their deadly flaw. They have zero redundancy and no ability to learn or heal from unexpected shocks. They are perfect until they are completely useless. The cat, by contrast, represents the natural, the organic, the robust, and often the anti-fragile. The cat is not optimized for a single task. It is optimized for survival across a wide range of unpredictable conditions. It has redundancy. It can walk with a limp. It has multiple senses. It regenerates tissue. It fails locally, a wound, a fall, but it does not fail globally. When a cat is thrown into a stressful situation, it doesn't break down. Its systems are activated. Its ancient, hardwired heuristics take over, and it learns from the experience. Its survival is not based on complex mathematical predictions, but on simple, time-tested rules of thumb, or heuristics, honed by millennia of evolution. The cat is robust because it is decentralized, redundant, and built with fat layers of safety and optionality, not hyperefficiency. It loves variability. Taleb uses this comparison to highlight the systemic risk inherent in the modern financial world, which overwhelmingly models itself after the washing machine. We mistake complexity for sophistication. We build massive, centralized systems like AI-driven hedge funds and quant strategies that rely on millions of lines of code and massive datasets. These systems work flawlessly 99.9% of the time, leading to incredible complacency. But when a rare, truly novel event occurs, a geopolitical crisis, a pandemic, or a sudden, unexplained flash crash, the entire system is proven to have a single point of cognitive failure. The highly optimized algorithm doesn't know how to adapt to the unprecedented. It simply locks up, panics, or executes trades in a cascading feedback loop that destroys value globally, confirming that the fragility was merely hidden within the hypercomplex, engineered efficiency. The critical lesson here is to differentiate between the simple and the simplistic. The cat is simple, but its underlying design is profoundly deep and anti-fragile. The washing machine is complex, but its underlying structure is shallow and fragile. When we build systems, be they financial, governmental, or personal, we must emulate the cat. Prioritize robustness through redundancy, decentralization, and reliance on simple, time-tested heuristics over complex, brittle algorithms that are certain to fail outside of their controlled environment. The truly safe strategy is the one that has survived millennia, not the one that was designed in a lab last week. Modern investing reflection. The financial market's embrace of the washing machine model is nowhere more evident than the rise of highly complex algorithmic trading and certain breeds of quant strategies. The goal of these systems is maximum efficiency, shaving milliseconds off a trade, optimizing portfolio allocation based on thousands of variables, and removing human emotion. This pursuit of efficiency is the ultimate Fragilista error. By removing all slack or fat from the system, they eliminate the natural buffers that absorb shocks. A small error in a traditional market might result in a localized, easily corrected mispricing. In a hyper-optimized algorithmic market, a small error can instantly cascade, triggering a flash crash that vaporizes billions in seconds. These events are the sound of the washing machine breaking down completely, a global failure caused by a single internal flaw. Contrast this with the investment strategy of dollar cost averaging into a simple global index fund, which Taleb would argue is a cat strategy. It is decentralized, using the power of the entire global economy, redundancy. It is based on a simple, ancient heuristic: time in the market beats time in the market. It is not an optimized algorithm designed for peak performance. It is a robust process designed for guaranteed, non-fragile survival. When volatility hits, the system doesn't break. It simply buys more shares at a lower price, benefiting from the disorder, the definition of antifragility. The investor choosing between a complex, highly leveraged, actively managed multi-factor fund and a simple, unleveraged broad market ETF is essentially choosing between the washing machine and the cat. The former promises optimization and higher short-term returns, but guarantees massive, hidden systemic fragility that will express itself during the first major crisis. The latter promises average returns, but guarantees structural robustness and anti-fragility, ensuring that the investor survives the global inflation waves and social media financial panic cycles with their core capital intact, ready to take advantage of the chaos when others are being liquidated. The cat doesn't predict the storm. It simply knows how to fall and land on its feet, ready to hunt again. Chapter 4. The Turkey and the Black Swan. This chapter contains perhaps the most famous and chilling thought experiment in Taleb's entire body of work, the story of the turkey. It is the brutal, simple encapsulation of the danger inherent in forecasting, and the catastrophic flaw in systems that rely solely on past data to predict the future. The turkey problem is the ultimate demonstration of why complacency is the most deadly form of fragility. Imagine a turkey, born and raised on a farm. Every single day of its life, for 1,000 days straight, a benevolent farmer comes out and feeds it. The turkey observes this phenomenon daily. It collects data. It uses sophisticated, inductive reasoning. The farmer has provided food every day. Therefore, The probability that the farm will provide food tomorrow is extremely high, and the probability of sudden negative change approaches zero. With every passing day, the turkey becomes more confident, more certain, and more trusting of the established pattern. Its entire worldview is built on an ever-increasing confidence in the system's stability. The turkey is the ultimate fragile beneficiary of predictability. Then comes day 1001, Thanksgiving. On that day, the turkey receives a surprise, the Black Swan event that invalidates all 1,000 previous data points. The event is completely unexpected by the turkey, but entirely predictable by the farmer, the person with skin in the game and superior knowledge of the system's true design. The turkey's confidence, which peaked just before the slaughter, was a precise measure of its ultimate fragility. The turkey problem reveals a fundamental trap of epistemic arrogance, the mistake of concluding that the absence of evidence for a catastrophe is the same as the evidence of its absence. This failure of induction is the reason why highly leveraged financial institutions, supposedly run by geniuses with PhDs, manage to collapse so spectacularly. They build models based on 50 years of data, but those 50 years only contain predictable, manageable fluctuations, the daily feeding. They fail to account for the single rare event that lies outside the historical dataset, the one event that is designed to happen on day 1001 and wipe out all the accumulated profits. Taleb points out the devastating, nonlinear consequence of time. The longer the period of stability, the greater the eventual shock. When volatility is suppressed, when the market or the farm is kept artificially smooth and quiet, the system is not becoming safer. Instead, all that suppressed instability is simply accumulating, building up pressure, ensuring that when the inevitable shock finally hits, it is not a small setback, but a total systemic annihilation. This is why small errors and frequent corrections are actually beneficial. They keep the system limber, responsive, and prevent the accumulation of catastrophic fragility. A period of calm is not safety. It is danger in disguise. The turkey is us when we are complacent. The turkey is a pension fund that assumes average returns will continue uninterrupted. The turkey is a regulator who believes they have eliminated risk because the market hasn't crashed recently. Modern investing reflection. In the 2020s, the financial market is a vast, technologically advanced turkey coop, and the ease of cheap leverage through technology has made the slaughter potentially far messier. For much of the last decade, particularly after the 2008 crisis, central banks and geopolitical forces worked to suppress volatility, creating an artificially smooth environment. This multi-year period of relative calm was the daily feeding, convincing investors that low interest rates and high returns were the natural order. This environment directly fueled the leverage addiction and option gambling we see today. Why? Because the risk was invisible. The investor who consistently uses 2x or 3x margin on their portfolio, or who sells uncovered options promising small, consistent premiums, is acting exactly like the turkey. They rely on the pattern of stability, continuing for the next month, the next quarter. The profits are small and frequent, the daily feed, but the underlying strategy is acutely fragile. When the single global inflation wave or the rare, sharp liquidity crisis hits, the financial Thanksgiving, the leverage which amplified the daily gains, now amplifies the losses, leading to an immediate margin call and total wipeout. Their confidence level was the highest right before the system broke. This mentality has been amplified by the FIRE-based asset allocation models that assume a smooth 7% annual return for the next 30 years, giving rise to hyper-speculative behavior as investors chase higher yields to speed up the timeline. While the core FIRE principle is sound, subtractive via Negativa, the turkey's flaw creeps in when investors start assuming zero volatility or zero Black Swans on their multi-decade journey. The lesson of the turkey is not to avoid risk entirely, but to ensure that your strategy does not rely on the absence of extreme events. The anti-fragile investor understands that the Black Swan is inevitable and structures their portfolio not to be harmed by it, but to benefit. They hold a core position that is structurally robust, low leverage, diversified, and keep their high-risk bets, the optionality, small, clearly defined, and isolated. They ensure that if the market experiences its Thanksgiving, their entire farm is not on the chopping block, but rather they are prepared to profit from a necessary structural reorganization that follows catastrophic disorder. They are the farmer, not the flock, I understand you want the next 3 chapters, Chapter 5, Chapter 6, and Chapter 7, written together. This ensures a significant increase in the script's word count and maintains a cinematic flow. Here are the detailed, expanded breakdowns for Chapters 5, 6, and 7 of the script for Antifragile. Things I gain from disorder. Chapter 5. The Essential Triad, Fragility, Robustness, and Antifragility. Having introduced the 3 concepts, Taleb dedicates this chapter to formally defining the difference between fragility, robustness, and antifragility through the lens of asymmetry and nonlinear response. This is where the philosophy of antifragility transforms from an abstract idea into a practical, mathematically grounded system for evaluating risk. We are forced to look beyond mere labels and observe how a system responds to variance, to disorder, and to the unpredictable movement of the world. The core distinction lies in how the results of small, frequent fluctuations compare to the results of large, rare shocks. The fragile is characterized by a concave response to volatility. Imagine a curve that slopes gently upward for positive inputs, but drops sharply downward for negative inputs. For the fragile entity, the pain of a single, large shock is exponentially greater than the cumulative benefit of many small, positive events. A highly optimized, leveraged portfolio is the perfect example. It gains steadily and incrementally on good days, the small, positive variance. But a single, sudden market correction, the large, negative variance, wipes out all those small gains and then some, often resulting in total loss of capital. The loss of 10% on your total portfolio is always far more damaging than the gain of 10% is beneficial, because the loss requires a much larger percentage gain just to break even. This is a death trap of fragility. The asymmetry works against you. The robust entity, conversely, exhibits a roughly linear or flat response. It is indifferent to volatility. The steel cube we discussed earlier is neither helped nor harmed by moderate shock. It uses energy to maintain its state, but it is fundamentally limited. Its best-case scenario is simply survival, retaining its initial value. In finance, this might be represented by a portfolio consisting purely of cash or short-term government bonds. It will not be destroyed by a crash, but it will also not grow from market disorder, and its robustness comes at the cost of long-term opportunity and real returns, especially during global inflation waves. It is safe but stagnant. The antifragile is defined by a convex response. This is a desired state. For the antifragile entity, the potential gain from a large, rare, positive event far outweighs the potential loss from a frequent, small, negative event. The curve is weighted toward the upside. It actively thrives on variance. This is the property of optionality, the right to take advantage of favorable outcomes without the obligation to suffer the corresponding unfavorable ones. The cost of failure is small and known, the premium paid, the initial investment lost. But the benefit of success is large and unbounded. The ability to endure small, harmless failures and simultaneously maintain exposure to massive, nonlinear wins is the essence of antifragility. The profound insight of this triad is that you don't need to predict the size or timing of the shock. You only need to determine your exposure to it. When you are concave fragile, you should avoid volatility at all costs. But since volatility is inevitable, this is a losing game. When you are convex antifragile, you should actively seek and encourage volatility, using it as a signal, a corrective mechanism, and a source of opportunity. Modern investing reflection. The essential triad provides a perfect diagnostic tool for the modern investor, particularly the investor seduced by cheap leverage through technology. When a retail investor engages in leverage addiction through margin trading or high-risk option strategies, they are intentionally choosing the concave payoff function. They are amplifying the downside asymmetry. For example, buying meme stocks on margin is the epitome of fragility. It maximizes small daily gains, but guarantees total ruin when the inevitable 50% drop occurs. Their portfolio is built to break. The classic diversified, unleveraged, passive investing portfolio, the broad market ETF held for decades, can be considered robust. It will suffer paper losses during a crash, but the system itself is not structurally destroyed, and the investor's capital remains to participate in the recovery. It is built to endure, but not necessarily to benefit dramatically from the disorder. The truly anti-fragile strategy in today's market is often the barbell strategy. which we will discuss in depth later, but it is conceptually rooted here. This involves keeping 90% of core capital in a robust, low-risk bucket cash, short-duration bonds, simple indexes, and putting a small, non-concave 10% into highly speculative, high-optionality bets, like early-stage Bitcoin bubbles, truly disruptive technologies, or distant out-of-the-money options. This 10% is expendable and costs little if it fails. But if one of those bets becomes a Tesla-hype success story, the nonlinear gain funds the entire portfolio for years. The anti-fragile investor structures their risks so that they benefit, rather than suffer, from the random movement of the market. They swap small risks of ruin for small risks of loss, in exchange for unlimited upside. Chapter 6. Narrative Fallacy. The emotional and the rational. The human brain is a magnificent, highly evolved machine, but it is fatally flawed when it comes to dealing with randomness. This flaw is a narrative fallacy, the central theme of Chapter 6. This fallacy refers to our desperate, innate need to fit a story, a simple explanation, or a cause and effect chain to a sequence of facts that are often random, complex, and driven by unknown forces. We are storytelling animals, and this compulsion to create order where none exists is the root of massive emotional and financial fragility. When a major market crash occurs, the financial media, the experts, and the public instantly scramble to construct a story. The crash was caused by the trade war, or it was the inverted yield curve, or it was the Federal Reserve's sudden rate hike. Taleb argues that while these factors are in the sequence of events, they are rarely the cause. The true cause of a Black Swan event is often an obscure, non-linear interaction within the complex, interconnected system, a cause that is inherently unnarratable. We are simply confusing sequence with causation. The danger of the narrative is that it breeds false confidence. Once a simple story is accepted, we believe we have understood the event, making us believe we can predict or prevent the next one. This creates profound hindsight bias. We look back and say, of course, the crash was obvious, when in reality, no one was truly positioned for it. This false understanding makes us more fragile, as we prepare for the last war, not the next one. In the market, the emotional and the rational constantly clash, but the narrative is the bridge that links them, often poisoning the well. People don't buy or sell based purely on earnings reports. They buy or sell because of the story. The captivating narrative of a world-changing technology, the simple, reassuring story of perpetual growth, or the terrifying, contagious story of impending doom spread through social media financial panic cycles. This is the lifeblood of FOMO culture. The fear isn't just about losing money. It's about missing the story everyone else is participating in. The narrative fallacy blinds us to the true nature of the world, which is governed by extremism, where large, unpredictable jumps dominate the data. The only way to guard against this psychological frailty is to actively embrace the unknowable, to train ourselves to look at outcomes without demanding a neat explanation, and to remember that correlation and coincidence are not causality. True knowledge often lies in knowing what doesn't work, not in having a compelling story about what does. Modern investing reflection. The entire ecosystem of financial influencers and crypto hype cycles is built on a narrative fallacy. Take the sustained Tesla hype over the last decade. Was the stock valuation purely about the number of cars sold? Absolutely not. It was driven by the narrative of the visionary founder, the story of disrupting old energy, the captivating mythology of a company that existed outside normal corporate rules. Investors bought the story, not the spreadsheet. The moment the narrative began to wobble, perhaps due to a minor production delay or a controversial tweet, investors who bought based on a flimsy story often panicked and sold, proving their fragility was based on a psychological error, not a fundamental one. Similarly, much of the Bitcoin bubbles are fueled by a compelling narrative. The story of decentralized power, the separation of money and state, and the potential for exponential generational wealth. These are powerful stories, and they are essential for driving momentum. The danger comes when investors try to create a rational narrative for why the price moved from $40,000 to $60,000 a month. They invent reasons after the fact, creating a false sense of explanatory power that encourages more volatile and fragile behavior. The truly anti-fragile investor understands that stories sell assets, but they also cause crashes. They do not allow the compelling narratives circulated by financial gurus and viral videos to drive their core financial decisions. They understand the power of the narrative, but they use simple, robust, non-narrative dependent heuristics like the Barbell Strategy or dollar cost averaging to manage their risk, separating their investment decisions from the emotional contagion of the crowd. They are insulated from the panic because their strategy is based on structural preparation, not narrative prediction. Chapter 7. The Problem of the Expert or the Fragilista. This chapter directly confronts the most dangerous source of systemic fragility in the modern world: the centralized high modernist planner, the academic theorist, the regulator, or the consultant, the person Taleb famously labels the Fragilista. The Fragilista is a specific type of expert, characterized not necessarily by lack of intelligence, but by the separation of their decisions from the consequences of those decisions. They suffer from the problem of the expert. The Fragilista's harm is structural. They operate with the belief that they can understand, model, and control complex systems from the top down. They believe they can suppress natural, healthy volatility to achieve smooth efficiency, often through unnecessary intervention, a phenomenon Taleb terms iatrogenics, harm caused by the healer. When an economist uses complex models to justify unprecedented central banking policy that keeps interest rates artificially low for a decade, they suppress small, necessary economic cycles. This created a massive hidden buildup of systemic risk, making the entire economy act like a tightly coiled spring ready for a catastrophic break. The economist, however, is not personally bankrupted when the bubble bursts. Their tenure remains intact. This lack of skin in the game is the moral and practical driver of fragility. The person who makes a decision must bear the risk of failure for the system to remain healthy and honest. When the banking executive takes massive risks, knowing they will receive the bonuses during the upswing, but the taxpayer will bear the loss during the downturn, the entire system is designed to be anti-fragile for the executive and acutely fragile for society. This transfer of fragility is the great moral outrage of the modern system. The key danger is the centralization of decision-making. Natural, distributed systems, like biological evolution or decentralized markets, have built-in checks and balances. Failures are local, corrected quickly, and serve as valuable feedback. The Fragilista, however, attempts to impose a single, complex solution on millions of independent actors. When their single, complex model is wrong, and it will be because complex models cannot account for the Black Swan. The failure is total, simultaneous, and global. Robo-advisors in complex, uniform quant strategies risk becoming modern fragilistas. They optimize portfolios based on centralized, elegant theories, but the core assumption of the algorithm fails. It creates a single point of failure across millions of client accounts. Taleb insists that we must shift our respect from the academic, credentialed expert who lacks skin in the game to practitioner, the plumber, the options trader, the traditional craftsman, whose knowledge is born of trial and error, survival, and the constant, painful feedback loop of consequence. Their knowledge is robust because it is built from the bottom up through surviving chaos, not predicting it. Modern investing reflection. The rise of the financial TikTok and YouTube gurus perfectly illustrates the fragilista problem in the retail investing world. These figures dispense frequent, confident, high-risk advice, often advocating for concentrated positions, option gambling, or aggressive use of cheap leverage. They have an immense amount to gain: views, advertising revenue, followers, if they are right once, but zero personal financial consequence if their followers are wiped out. They are the ultimate example of advice without skin in the game, a textbook fragilist operation. They create fragile investors who believe they are following a genius, when in fact they are following someone whose primary incentive is self-promotion, not fiduciary soundness. The broader systemic fragilista is the entity or technology that encourages fractional shares culture and zero-commission trading, while simultaneously providing access to highly complex, leveraged products. The platform makes trading frictionless and efficient, a fragilista's goal, but in doing so, it encourages constant, high-frequency intervention and day trading psychology in the 2020s, which is structurally fragile. The system optimizes for transaction volume, the platform's gain, and hides the true, catastrophic risk borne by the retail investor, the public fragility. The antidote to fragilista is the decentralization of decision-making, the rejection of complex, top-down theories, and insistence that anyone giving advice or running a system must have their personal destiny linked to its outcome. For the individual investor, This means prioritizing simple, transparent strategies over complex, highly optimized ones, and never trusting someone who benefits when you lose. I understand. To continue building this massive cinematic script, here are the next 3 chapters. Chapter 8, Chapter 9, and Chapter 10, totaling over 1,800 words of detailed analysis and modern context. Chapter 8, Glass Ceilings and Soft Floors. Chapter 8 formalizes the structure of the anti-fragile position, introducing the concept of optionality as the key architectural element. Optionality is not merely a financial derivative. It is a life strategy defined by having a favorable asymmetry, the potential for infinite nonlinear upside, the glass ceiling, combined with a guarantee of minimal, contained, and survivable downside, the soft floor. The goal is to maximize your exposure to positive randomness while ruthlessly minimizing your exposure to negative randomness. The soft floor is the foundation of all antifragility. It represents your absolute minimum outcome, the state of affairs below which you cannot fall. It is the guarantee of survival. For a company, the soft floor might be enough cash reserves to survive a 2-year revenue drought. For an individual, it is a lack of excessive debt, the possession of simple, liquid assets, and a low mandatory spending baseline. When you have a soft floor, small failures, the daily fluctuations, the minor business setbacks, the market corrections cannot kill you. They only serve as inexpensive feedback mechanisms that allow you to adjust and learn. The moment you introduce leverage addiction or unlimited liability, you destroy your soft floor, turning a survivable stumble into a fatal freefall. The glass ceiling is the complementary side of optionality. This represents the unlimited, non-linear payoff from a Black Swan event. It is the ability to benefit disproportionately when the unexpected happens. The beauty of the glass ceiling is that it requires only small, measured inputs to hold the option. You don't need to predict when or how the market will jump. You just need to ensure you have a ticket to ride when it does. This could be a tiny, diversified basket of highly speculative technology stocks, or the maintenance of human capital, skills, network, reputation, that allows you to suddenly capitalize on a massive, structural change in the economy. This is where Taleb's philosophy of the barbell strategy, keeping 90% hypersafe and 10% highly speculative, finds its intellectual mooring. The common tragic error is that most people mistakenly choose a strategy that offers a hard floor, no short-term volatility, but sudden catastrophic failure, and a low, finite ceiling, limited returns. They choose a safe job with a predictable salary and the pension fund that cannot fail, only to find the entire industry is wiped out by disruption, or the pension fund's assets suddenly vanish due to systemic fragility. The anti-fragile life actively seeks out situations where losses are capped, but gains are unbounded. This principle changes every decision, from career choice to portfolio design. You should seek careers where failure is a cheap learning experience, soft floor, and success means exponential opportunity, glass ceiling. Modern investing reflection. The pursuit of the soft floor and the glass ceiling provides a clear ethical and practical map for the modern investor navigating FOMO culture. Consider the investor who engages in option gambling by selling covered calls or puts for small, consistent premiums. They believe they're generating predictable income, a stable but low ceiling, while accepting a potentially infinite downside, the stock rising or falling dramatically, leaving them exposed to massive, nonlinear losses. This strategy has a low, finite gain and a virtually unlimited, hard floor downside. It is the definition of fragility. Conversely, the investor who buys small amounts of deep out-of-the-money calls on a disruptive stock or holds early-stage Bitcoin is creating a true, inexpensive option. Their maximum loss is the cost of the option. The soft floor is maintained. But their maximum gain if the asset explodes, the Tesla hype scenario, is theoretically infinite, the glass ceiling. This is true optionality, where the volatility that destroys the concave investor is the very engine that powers the convex investor's gains. Even in the world of ETF dominance, this principle holds. Simply holding a broad index fund provides a good baseline of robustness. But the truly anti-fragile investor should seek optionality outside that core. This means having non-market correlated assets, maintaining high cash reserves, liquidity as a soft floor, and always preserving human capital. the skill set that allows you to rapidly adapt to a post-Black Swan economy as their greatest source of glass ceiling. The FIRE movement investors should prioritize simplicity and low cost to create their soft floor, then leverage their time and skills, not their borrowed money, to create the exponential upside. Chapter 9, the sweetness of doing nothing. If the goal is to establish a soft floor and an unlimited ceiling, Chapter 9 tells us how to defend that precious asymmetry by embracing strategic inaction, or what Taleb calls the sweetness of doing nothing. This is the ultimate application of via negativa to decision-making, emphasizing that in a complex system, most interventions and most decisions driven by anxiety are not just useless, but actively harmful. The problem starts with the noise. The modern investor is constantly bombarded by financial information, financial gurus screaming daily forecasts, the ticker tape moving incessantly, and the social media financial panic cycles demanding an immediate reaction. Most of this information is irrelevant noise. Small, frequent fluctuations have zero predictive power for the large, decisive Black Swan events. Yet, the existence of this noise creates a tyranny of the urgent, pressuring investors to act, to trade, to adjust, simply because they have the tools, like zero-commission trading, that make intervention frictionless. Every time you intervene, you introduce the risk of iatrogenics, the risk of causing harm through your own action. If you believe you have a robust or antifragile position, a soft floor, the default, safest action is silence and stillness. The system is designed to correct itself and benefit from small shocks. By intervening, by checking your portfolio multiple times a day, by trying to time the market, by engaging in day trading psychology in the 2020s, you're introducing human error, anxiety, transaction costs, and complexity into a system that thrives on simplicity. The Fragilista, the person with no skin in the game, is always incentivized to push for action because action generates fees and the illusion of control. The sweetness of doing nothing is not laziness. It is profound emotional discipline and deep statistical intelligence. It is a recognition that, statistically, you are most likely to increase your fragility through active intervention. The most successful investors often cite the power of sitting still, letting time work its magic, and allowing a natural upward drift of the economy to unfold while avoiding the catastrophic loss that comes from panicking at the bottom. Doing nothing allows the soft floor to remain intact and gives a long-term, convex options the necessary time to materialize into a glass ceiling event. The path to antifragility requires one to consciously, structurally resist the constant psychological and technological push toward action, recognizing that time in the market is far more robust than timing the market. The true signal that requires intervention is rare and usually relates to a genuine change in your core thesis or circumstances, not a temporary, fleeting movement in price. Modern investing reflection. The invention of zero-commission trading has monetized the tyranny of the urgent, turning the retail investor into a compulsive button pusher, perfectly illustrating the financial cost of noise. Before zero-commission platforms, trading carried a friction cost, a broker fee, which acted as a natural brake. Enforcing a form of via negativa, it discouraged constant, unnecessary action. By removing this friction, the platforms have encouraged day trading psychology and high-frequency noise trading, which benefits the platform through data and payment for order flow and benefits the emotional side of the investor, the feeling of doing something, but systematically harms the investor's long-term returns. The system is now anti-fragile to the brokerage and fragile to the client. The antidote is the adoption of a don't-look strategy. The success of passive investing is fundamentally the success of not doing anything. The passive investor commits to a plan, automates a contribution, dollar-cost averaging, and then consciously removes their eyes from a market noise for years or decades. This silence is what allows their capital to survive the minor crashes and benefit from the major recoveries. It is a practical application of the cat analogy. The system, the ETF, is designed to handle the disorder, and the human's best contribution is to get out of the way. This principle is even more vital when facing asset classes defined by volatility, such as Bitcoin. The price fluctuation of Bitcoin or any highly speculative asset generates intense noise. The investor who watches the price daily is likely to sell during a panic, harmful action, or buy during a frenzy, harmful action. The investor who establishes a small optionality-driven position and then goes into a state of do nothing allows the convexity of the asset to work for them, undisturbed by the daily, unnecessary noise. The greatest act of financial discipline today is often the power button. Chapter 10, The Nonlinearity of the Fragile and the Antifragile. With Chapter 10, we enter Book 2, shifting focus from the simple concept to the complex issue of how these properties, fragility and antifragility, scale. Taleb shows that the response to disorder is rarely linear, and understanding this nonlinearity is critical to grasping how systems survive or collapse, particularly in the realm of modern centralized institutions. Nonlinearity simply means that an input change does not result in a proportionate output change. If a system is fragile concave, a small increase in stress might cause a massive, disproportionate increase in damage. If a system is antifragile convex, a small increase in opportunity might cause a massive, disproportionate increase in gain. This disproportionate response is precisely why the world is dominated by extremism, where a few rare events dictate the majority of the consequences. The core lesson here is the fragility of large size. When a biological system, like a community of small businesses, grows larger, it becomes more robust because it is decentralized and diverse. But when an engineered system, like a massive, centralized government or a globally interconnected bank, grows larger, it becomes exponentially more fragile. This is because large size and centralized control eliminate the necessary redundancy and local failures that provide feedback and correction. A small, local bank failure is good, providing feedback to the system. A giant bank failure is catastrophic because the nonlinearity of its size means its failure cascades globally and requires a massive, nonlinear intervention, the taxpayer bailout. The error is magnified nonlinearly. The opposite is true for antifragility. The small, successful startup or the early investment in a disruptive technology benefits from a nonlinearity of optionality. A 10% increase in market adoption for a small company might lead to a 1,000% increase in stock price because the market is re-rating its potential in a nonlinear fashion. Antifragility benefits from scale, but only when the gains are captured without the risk being transferred to the center. This chapter is a mathematical underpinning for why the barbell strategy works. You are keeping your risk localized and linear, but your potential gain is non-localized and non-linear. The essential takeaway is to always check how your systems respond to a small perturbation versus a large one. If the large perturbation hurts you disproportionately more than the small one helps you, you are dealing with fragile, non-linear disaster waiting to happen. If the large perturbation can help you disproportionately more than the small one hurts you, you are successfully positioned for antifragility. Modern investing reflection. The nonlinearity of scale is a hidden risk behind the current structure of global finance, specifically the phenomenon of index funds dominating global wealth. As money flows increasingly into a handful of massive, highly correlated index ETFs, the scaling of fragility becomes an acute threat. While the index fund itself is robust for the individual, a cat model, the collective size of these behemoths creates a systemic washing machine problem. When a massive event, like a sudden geopolitical shock or an extended global inflation wave, forces widespread selling, the nonlinearity means that a small percentage of forced redemptions can cause a disproportionately massive cascade because the selling is undifferentiated across thousands of stocks simultaneously. The failure is not localized. It is amplified by the massive, centralized pool of capital. Furthermore, the nonlinearity drives explosive price action in assets like Bitcoin bubbles and concentrated tech stocks. The underlying fundamentals rarely justify a tripling of the price in a few months. Instead, the market is nonlinear. Once a certain threshold of adoption or conviction is crossed, the price becomes driven by the narrative of exponential possibility, creating massive convex gains for early holders. This is a perfect example of optionality paying off nonlinearly. The danger of algorithmic trading is also rooted in nonlinearity. Algorithms work flawlessly in normal, linear conditions, but a rare market condition causes them to hit an edge case, and their nonlinear response is to panic sell simultaneously. This is a flash crash phenomenon, a small initial input, an erroneous trade, or a sudden change in sentiment, leading to a massive nonlinear global output, a market-wide collapse. The antifragile investor must avoid being caught in these nonlinear, collective failures by maintaining systems that are small, decentralized, and governed by simple rules. I understand. I will continue the script expansion with the next 3 chapters, ensuring they are deeply detailed, maintain the premium audiobook style, and exceed the required word count. Here are the scripts for Chapter 11, Chapter 12, and Chapter 13, focusing on the crucial concepts of decentralization, the Barbell Strategy, and the Fallacy of top-down expertise. Chapter 11, The Servant and the Agent. This chapter explores one of the most insidious ways fragility is introduced into complex systems, through the misunderstanding of control, specifically confusion between a servant model and an agent model. This is a framework for dissecting centralized authority and the catastrophic results of over-reliance on top-down direction. The servant system is one where central authority gives simple, clear, and unambiguous commands to its components, which execute them mechanically. A traditional factory assembly line or a simple corporate hierarchy, where middle management simply passes down dictates, is a servant system. This system is highly efficient only in predictable, narrow environments. However, when the environment introduces complexity or novelty, a true black swan, the servant system breaks, because the components have no autonomy, no capacity for local adjustment, and no means to feed novel information back up to the central command. The brain of the operation is too far removed from the sharp end of the execution, and fragility is latent in the centralized decision-making itself. The agent system, by contrast, is a decentralized network where each component or agent is granted significant autonomy and the ability to make local decisions based on real-time feedback. Each agent is like a semi-independent entity, often possessing its own skin in the game and acting according to simple, time-tested heuristics rather than complex, centralized commands. The human body is an agent system where millions of cells and organs operate semi-autonomously, constantly self-corrected without instruction from a central government. The economy, when truly free, is an agent system where millions of entrepreneurs, acting on local knowledge and personal consequences, constantly generate innovation and correct errors. The power of the agent system is its anti-fragility. When a shock hits a decentralized network, the failures are localized. One agent or one component may fail, but this failure provides vital information and resources to surrounding agents, allowing the system as a whole to adapt and strengthen. The constant, small failures are not weaknesses. They are cheap insurance premiums paid to prevent systemic collapse. Centralization, by its very nature, creates a single point of failure, ensuring that when the command center is wrong, everyone is wrong simultaneously. This framework reveals the core Talebian insight that the most fragile systems are those where the decisions are made far away from the risk by people who operate in an insulated servant bubble, while the consequences are borne by the agents on the ground. The regulator who mandates a complex risk management model across an entire banking sector is a servant. The local bank manager who knows his customers and his market is the agent. The servant system always privileges the illusion of control and predictability over the messy, anti-fragile reality of local, decentralized learning. Modern investing reflection. The struggle between the servant and the agent is playing out dramatically in the 2020s through the rise of decentralized finance, DeFi, and the debate around central authority. Crypto hype cycles are built on the foundational concept of the agent system. Bitcoin, for example, is the ultimate agent system. It has no central command, no servant, only a distributed network of thousands of individual nodes, agents, governed by simple, inviolable rules of protocol. This decentralization is what makes it anti-fragile to political control, censorship, or a single point of failure. The volatility is a system's health. It is a constant, visible, necessary feedback that prevents fragility from accumulating and allows it to survive every external shock. Conversely, the centralized system of ETF dominance and large AI-driven hedge funds represent a form of servant control. While the index funds themselves are diverse, the sheer aggregation of capital into a few massive, passively managed vehicles means that the market's pricing mechanism is becoming less driven by the local knowledge of individual agents' active stock picking, and more by the single, blind mandate of the central asset allocator, the servant. If the central mandate or the fundamental assumption of passive indexing fails, the servant commands a simultaneous, massive movement of capital that creates a single point of financial fragility, for the entire global market. The investor should apply this principle to their own portfolio management. They must avoid being a servant to external commands, never following a single financial guru or adhering rigidly to a single, complex model. Instead, they must become an agent, relying on decentralized, bottom-up knowledge, simple rules, personal skin in the game, and a system that adapts to local, personal circumstances rather than optimizing for global, theoretical perfection. The servant seeks efficiency and risks ruin. The agent seeks robustness and finds optionality. Chapter 12. The generalization of the barbell. This is arguably the single most important practical lesson in the entire book. The barbell strategy or bimodal strategy is a concrete architectural solution for achieving antifragility in a world defined by black swans. It is a tactical application of the soft floor and the glass ceiling concept. A barbell is defined by extreme concentration at two opposite ends, with virtually nothing in the middle. It is a purposeful avoidance of mediocre middle, the place where hidden risk is most often accumulated. The standard approach to risk is the monomodal approach, putting all assets in a moderate risk, moderate reward portfolio like a traditionally balanced fund, e.g., 60% stocks, 40% bonds. Taleb argues that this moderate approach is actually the most fragile because it ensures you lose a moderate amount of capital in the most probable events while still maintaining enough hidden. Exposure to be ruined by the catastrophic, rare event. You are taking enough risk to be harmed by the black swan, but not enough to benefit significantly from the occasional large gain. You are paying for the illusion of safety. The barbell strategy demands a radically different allocation. The hypersafe end, the soft floor of this bucket, must contain the vast majority of your assets, e.g., 85% to 95%. These assets must be hyper-robust to extreme volatility, meaning cash, inflation-protected bonds, or completely unleveraged, broad market index funds. This capital must be protected against ruin at all costs. The goal here is simple: survival and maintaining liquidity, optionality. This is the base that allows you to confidently do nothing during a panic. The highly speculative end. The glass ceiling in this bucket contains a small, known, and expendable portion of your capital, e.g., 5% to 15%. This is where you place small bets that offer unlimited, non-linear optionality. This capital can be invested in anything that has a potential for a 100x or 1000x return, early-stage venture, high risk, and proven technologies, or deep out-of-the-money options. The loss of this entire 10% stake must be survivable. It is the insurance premium you pay for exposure to positive black swans. The barbell is anti-fragile because the safe end guarantees you survive the negative black swan, and the speculative end guarantees you profit massively from the positive black swan. Crucially, the barbell must be asymmetrical in its payoff, not just its size. The small speculative bets must have an exponential potential, convexity, to compensate for the fact that most will fail. The barbell is not about balancing risk. It is about separating risk of ruin from risk of loss, and using the latter to pursue massive upside. Modern investing reflection. The barbell strategy is the only sane response to a market characterized by hyper-speculative behavior and social media financial panic cycles. The vast majority of investors are stuck in a fragile middle, constantly rotating between moderate risk funds and getting drawn into high-flying meme stocks or crypto hype cycles with too much of their capital, mistaking the moderate middle for safety. The true application of the barbell in the 2020s involves the safe end. For the FIRE movement investor, this means prioritizing simple dollar cost averaging into broad, unleveraged ETFs until their soft floor, a multi-year cash reserve, is untouchable. The discipline is in avoiding leverage entirely on this large portion, as leverage destroys the soft floor. The speculative end. Instead of betting 50% of your portfolio on the next Tesla hype, the barbell approach dictates you limit your total exposure to that single speculative asset to a small, expendable, fixed percentage. This allows you to participate in the FOMO culture, to have a ticket to the upside without putting your survival at risk. This small 10% is where you place your option gambling bets, knowing that the structural gain of the barbell comes from optionality, not prediction. The barbell is also a time management strategy. Taleb suggests spending 90% of your time on simple, robust activities, reading classics, spending time with family, engaging in physical labor, and 10% of your time on highly open-ended, non-linear projects, writing a book, learning a complex new technology. You avoid the fragile middle, the endless meetings, the emails, the moderate-risk social calendar that offer little reward but take up most of your energy. The barbell is a life philosophy of extreme safety and extreme exposure, rejecting the lukewarm, moderate existence that is the most susceptible to hidden fragility. Chapter 13, Teaching Birds How to Fly. This chapter is a devastating critique of the central flaw in modern expertise, the belief that knowledge can be reliably transferred from the abstract, academic model to the messy, complicated real world. Taleb uses a vivid image of an expert trying to teach a bird how to fly to highlight the vast, often dangerous, gap between theoretical, bookish knowledge, episteme, and practical, experiential knowledge, techne, or phronesis. The bird, through millions of years of evolutionary trial and error, possesses tacit knowledge that is ingrained, non-articulated, and demonstrably successful. It knows how to fly because it has survived. The expert, using complex Newtonian physics models and aerodynamic equations, might try to optimize the bird's flight by adding complex, unnecessary rules. This intervention, despite being mathematically correct in a laboratory setting, almost always introduces fragility to the bird, whose own simple heuristic is already robust and anti-fragile. This fallacy is the problem of top-down interference. True, lasting knowledge in complex domains like market or biology is almost always subtractive and bottom-up. It is a result of continuous, small errors and necessary adjustments, the constant local failures that create systemic robustness. The knowledge that survives is the knowledge that has been filtered by the brutal selection process of reality. Yet, the Fragilista and the intellectual yet idiot, IYI, believe that they can construct a superior system from the top down, ignoring the accumulated wisdom of the ground-level practitioners. This leads back to the problem of skin in the game. The bird-teaching expert has no consequence if the bird fails. Therefore, their focus is on the elegance of their model, not the survival of the system. In finance, this is the academic economist who proposes massive market-wide reforms but has never executed a trade with their own money, or the robo-advisor built by coders who have no personal exposure to a catastrophic market tail event. They are all teaching birds how to fly, adding complexity and fragility to systems that are best left to their own ancient, self-correcting mechanisms. Taleb urges us to respect the knowledge derived from survival above all else. If an ancient practice or a simple rule of thumb has survived for millennia, it is not because it is mathematically elegant. It is because it is robust to black swans. It has been stress-tested by time. The complex, highly optimized, top-down theory, by contrast, has not. It is prone to the fatal flaw of assuming the past is a perfect guide to the future and ignoring the nonlinear catastrophic effects of rare events. Modern investing reflection, the conflict between tacit knowledge and top-down expertise, is a defining battle of the contemporary financial marketplace, especially with the rise of AI-driven hedge funds and algorithmic trading. The AI-driven hedge fund is the ultimate top-down expert. It operates on the belief that by analyzing enough data, it can discover a complex, optimal strategy that is superior to human intuition. While these algorithms are brilliant at recognizing complex patterns in linear data, their knowledge is fragile when faced with novelty. They are designed to operate perfectly on the farm, but they have no mechanism to anticipate Thanksgiving, the truly unprecedented, non-linear market shock. Their complexity and reliance on abstract data make them prone to massive, simultaneous failure across the entire industry. Contrast this with the individual investor who uses dollar-cost averaging and simple value heuristics. This is a tacit knowledge of investing, a rule so simple it has survived centuries. It is not an optimal mathematical strategy, but it is an anti-fragile one. It does not require prediction. It is resistant to emotional panic, and it benefits from volatility. This ancient heuristic has survived because it passed the ultimate test, the test of time and chaos. Furthermore, this chapter is a core argument against trusting the modern financial TikTok and YouTube gurus. They present complex-sounding, top-down strategies, which stocks to buy, which options to sell, without demonstrating any long-term survival track record or, crucially, skin in the game. They are intellectual cheerleaders, teaching a fragile theory while separating themselves from the consequences. The only knowledge worth following is that which has been proven through survival of the practitioner, not the elegance of the theory. The anti-fragile investor must tune out the noise, reject the top-down optimization, and trust the simple, subtractive, time-tested wisdom that has survived the ultimate filter, the relentless chaos of the market. I understand. To continue the detailed expansion of the script, here are the next 4 chapters. Chapter 14, Chapter 15, Chapter 16, and Chapter 17, ensuring extreme depth and rich connections to the modern financial world. Chapter 14, When Two Antifragile Meet. This chapter moves beyond defining antifragility in isolation and examines what happens when multiple antifragile entities, systems that all benefit from chaos and disorder, begin to interact, particularly in a competitive landscape. The profound insight here is that when two systems thrive on variance, they create a necessary beneficial friction that, while appearing chaotic, is essential for the long-term health and innovation of the whole ecosystem. This is the argument for decentralization and against the artificial tranquility sought by centralized planners. Imagine a market full of small, independent agents, entrepreneurs, local businesses, niche traders, all competing fiercely. Each one is designed to fail locally and cheaply, but also designed to learn from that failure and adapt rapidly. When they compete, they generate volatility. They cause temporary disruptions, and they constantly challenge the status quo. This environment might look messy and inefficient from the top, but the collective result of their friction is a robust, rapidly evolving system. The friction between two anti-fragile competitors is not a destructive force. It is the engine of progress. The struggle is what keeps the system honest, resilient, and primed for the next leap forward. Taleb uses the example of biological evolution. Species are anti-fragile, and they improve precisely because they are in constant, brutal competition with each other and their environment. The failures, the extinctions, the mutations that don't survive, are critical feedback mechanisms. When a system is allowed to become too centralized or monopolistic, when one entity becomes robust to external pressures and manages to suppress the competition, the anti-fragile friction, the entire ecosystem begins to accumulate hidden, catastrophic fragility. The single, massive entity, the monopoly, is fragile to sudden, revolutionary change because it has lost the ability to learn and adapt incrementally. It is the washing machine that hasn't experienced a small tremor in years. The crucial lesson is that fragility is transferred. When you eliminate competition and suppress volatility at the local level, e.g., through bailouts, overregulation that favors incumbents, or massive centralization, you are merely transferring that volatility to collective. You create a system where the small, frequent failures stop occurring, but the single, eventual failure becomes systemic and cataclysmic. True stability is not the absence of volatility. It is the presence of an anti-fragile capacity to absorb and benefit from constant, local, manageable shocks. The whole ecosystem becomes anti-fragile through the individual fragility of its parts. Modern investing reflection. The financial market's dynamic between passive versus active investing is a perfect modern struggle between anti-fragile friction and fragile uniformity. For the last decade, ETF dominance in the flow of capital into passive index funds has created a giant, robust, but potentially fragile entity. The core idea of passive investing, as discussed in Chapter 9, is individually robust. However, when the overwhelming majority of capital is forced to flow in lockstep with the index, the anti-fragile friction of price discovery disappears. Active investors, the agents who are trying to find the mispriced assets, making small, frequent errors and adjustments, are essential for the market's health. They are the friction that corrects the system. If everyone is passive, the market becomes fragile. Why? Because the price of a stock no longer reflects local knowledge, but rather a blind, centralized mandate to buy whatever is in the index. When a systemic shock hits, the lack of knowledgeable, localized agents means there is no one left to act as a counterweight. The centralized flow of passive funds turns the system into a giant, slow-moving servant that is unable to adapt. The competition between thousands of active, volatile, and anti-fragile traders is what provides a market with its immune system. By suppressing the active traders, the two anti-fragile entities meeting, we risk building a massive, uniform, and inherently fragile index bubble. This also ties into the growth of AI-driven hedge funds and algorithmic trading. When too many quants use the same complex models in the same datasets, they are effectively creating a single, centralized intelligence, a servant, even though they operate at different firms. When their shared model inevitably fails, a black swan they all missed, their actions become highly correlated, leading to a simultaneous collective panic. This is not anti-fragile competition. It is correlated fragility hiding under the guise of sophistication. The investor must always seek to align with the source of anti-fragile friction, the decentralized, simple, localized approach, and avoid the centralized, optimized, and ultimately fragile system of mass conformity. Chapter 15, The Poet and the Prostitute. This chapter, marked by its provocative title, delves into the nature of work, value, and reputation, forcing a distinction between activities that provide optionality and those that lead to increasing hidden fragility. It's an exploration of knowledge, time, and the compounding returns of human capital. The prostitute represents a person who trades a transactional, short-term service for money. Their value is immediate, highly visible, and perfectly linear. They receive payment immediately for their time and effort. Crucially, they are prone to a high degree of fragility because their income stream is constantly dependent on immediate demand, and their reputation is built on their latest interaction. Their lack of control over future demand and their constant need to transact creates a structurally unstable financial life, which is heavily susceptible to ruin from small shocks, e.g., a bad week, a temporary health issue, or a change in the market. The poet, in contrast, represents the person whose work provides compounding optionality. They spend years toiling in obscurity, writing, thinking, and create without any immediate linear payoff. Their work is a massive, long-term, low-probability bet. They may write 10 books that fail, but the 11th may become a timeless classic, generating massive, non-linear wealth and a reputation that compounds over centuries. The poet is anti-fragile because their failures are localized and cheap. They only lose time and effort. But their potential gain is exponential, the glass ceiling. Their reputation is not based on their last transaction, but on the entire, surviving body of their work. It has passed the ultimate test of time. Taleb extends this metaphor to all forms of knowledge and work. The true value of a pursuit is judged by its payoff structure. Are you engaged in a profession that provides small, immediate, and linear rewards, the fragile transactional path, or one that requires patience, allows for small, non-fatal errors, and offers immense, non-linear upside, the anti-fragile optionality path? The transactional path is based on prediction and control. The optionality path is based on patient, relentless exposure to positive black swans. The lesson is that you must treat your career and your knowledge as your most precious anti-fragile asset. You must invest in skills that are convex, skills that become exponentially more valuable when unexpected things happen, rather than skills that are only linearly rewarded under stable conditions. This is how you build a reputation that is robust and capable of surviving chaos, as opposed to a temporary fame that collapses the moment the market shifts. Modern investing reflection. The distinction between the poet and the prostitute is the crucial ethical filter for financial TikTok and YouTube gurus, and the structured day trading psychology in the 2020s. The typical financial guru is a prostitute of information. They gain immediate linear rewards, views, ad revenue, sponsorships by providing constant transactional advice about what to buy or sell today. Their content is fragile. It must constantly cater to the latest FOMO culture trend, like the meme stock manipulation or the most recent crypto hype cycle. If they stop providing immediate, transactional content, their income vanishes. They are structurally fragile because they rely on prediction and noise. The true poet of finance would be the patient investor, advisor, or writer who teaches timeless principles, encourages emotional discipline, and advocates for simple, robust strategies like the Barbell Strategy. They are not rewarded for providing daily trading signals. They are rewarded only if their philosophy survives the next market crash and proves itself robust over decades. Their value is nonlinear and compounding. The investor choosing between passive versus hyperspeculative behavior is choosing between a form of the poet and the prostitute. The one who engages in high-frequency trading, prostitute, gains small, frequent, linear rewards at a high risk of ruin, making their capital fragile. The one who patiently employs dollar cost averaging into a simple index fund for decades, Poet, is making a long-term, non-linear bet on the anti-fragility of capitalism itself, allowing time and compounding to provide the exponential payoff. The prostitute sells their future optionality for a small present cash flow. The poet preserves their optionality for a massive future reward. Chapter 16, Changes that Benefit the Change. This chapter deepens the understanding of how anti-fragile systems are fundamentally different from merely robust ones. It is about systems that don't just endure change. They are structured so that the act of changing itself provides a benefit. Taleb is focusing on the ultimate power of systemic redundancy, the need for errors, and the concept of hormesis. A robust system, like a stone, is protected against change. It fights to maintain its internal state, expending energy to repel all disorder. A system that benefits from change, however, sees every perturbation, every shock, and every error as an opportunity. This is the principle of hormesis, borrowed from toxicology. A small dose of a harmful substance is often beneficial, acting as a stressor that triggers a net positive adaptive response. We lift weights, a small trauma. To become stronger, we expose ourselves to small environmental variations to strengthen our immune system. The small, frequent changes are not problems. They are necessary maintenance that prevents a catastrophic system-wide failure. The systems that benefit from change are those built with redundancy and non-critical components. If a massive, centralized system is designed for 99.99% efficiency, the washing machine, it has no redundant parts and no ability to handle an overload. The next change that comes along will break it. The anti-fragile system, however, has fat and slack, extra resources, unnecessary components, and decentralized structures, which allow it to absorb the shock locally, analyze the change, and reorganize itself in a superior configuration. The slack is not inefficiency. It is insurance against systemic ruin and the necessary component for learning. When we apply this to knowledge, the change that benefits is the error. The scientist who runs 99 failed experiments is benefiting from the change. Each failure eliminates a known false path, narrowing the scope of inquiry and accelerating progress far more reliably than one successful theory. The financial system that has small, frequent, visible failures, bankruptcies, localized crises, is constantly resetting and correcting its excesses, making it anti-fragile. When regulators and central planners step in to prevent these small corrections, they are suppressing the very mechanism that allows the system to learn and benefit from change. They create a debt of instability that is paid back with interest during the inevitable large crisis. Modern investing reflection. The extreme volatility in the world of Bitcoin bubbles and the mechanics of day trading psychology in the 2020s are both driven by systems that benefit from change, but for different actors. Bitcoin is a prime example of a system that benefits from change. Every geopolitical shock, every regulatory threat, every time a mainstream fiat system wobbles, the narrative of decentralized money is strengthened. The volatility, the constant price swings, are not problems. They're the system's stress test, the hormesis that proves its core resilience to the user base. The system's robustness is constantly being verified by change, attracting more participants who seek refuge from the fragility of centralized banking. The volatility is the necessary cost of its anti-fragility. In contrast, the fragility of the zero-commission trading model is exposed when the individual investor fails to benefit from change. The day trader is constantly reacting to minute changes in the market, making small adjustments. They are trying to benefit from change, but because they are using leverage addiction and are trading in the fragile middle, their exposure is concave. They are attempting to adapt and learn, but their risk structure ensures that the one single negative change, a margin call, wipes out all the cumulative, small benefits they may have gained. They are paying the cost of change without the structural ability to reap the rewards of adaptation. The anti-fragile strategy is to position oneself to benefit from the change by holding ample cash reserves and having a low mandatory burn rate, the slack/redundancy. This ensures that when the market changes drastically, a major crash, a geopolitical shock, or a sudden technological shift, you have the capital and the psychological distance to observe the change, adapt your strategy, and buy assets at fire sale prices from those who are fragile and forced to sell. The cheap leverage through technology has created countless fragile entities, and the anti-fragile investor is prepared to profit from unnecessary structural changes and failures that follow. Chapter 17. The Skin of the Game Heuristic. This chapter formalizes the most vital ethical and practical filter necessary for navigating complex systems: the mandatory requirement of skin in the game, SIDG. This is not merely an ethical principle. It is a heuristic, a time-tested, simple rule of thumb that is the most reliable predictor of a system's long-term survival and honesty. Taleb argues that a failure to mandate SITG is the source of all systemic fragility and the great moral injustice of modernity. Skin in the game means that you must suffer the personal, financial, or physical consequences of your actions, particularly your decisions that affect others. The person who builds a bridge must be forced to walk across it. The banker who takes massive risks must have their personal wealth at stake. The advisor who gives advice must be personally invested in the same strategy they recommend. This heuristic is profoundly simple, yet it works because it instantly converts a theoretical, fragile, top-down approach into a practical, robust, bottom-up approach. When a decision-maker has SITG, their incentives are immediately aligned with the system's long-term survival. They are naturally incentivized to favor subtraction and simplicity via Negativa. Because complex, opaque systems conceal hidden risks that could wipe them out. They will naturally favor robustness and redundancy over hyper-efficiency because inefficiency is their safety buffer. SITG acts as an automatic, decentralized risk management mechanism that is far superior to any external regulation imposed by a Fragilista. The absence of SITG is the Fragilista's greatest weapon. The typical intellectual yet idiot, IYI, the forecaster, the academic, the politician, operates in an isolated bubble where they benefit from positive outcomes, fame, promotions, book sales, but bear none of the costs of negative outcomes. The taxpayer pays for bailout. The investor loses the money. They transfer fragility to the unsuspecting public. This systemic transfer of risk, this ability to benefit from the upside while transferring the downside, is what creates massive hidden and systemic fragility. The skin in the game heuristic is the only way to effectively vet both knowledge and advice. If someone gives you advice, but has no personal downside if that advice is catastrophic, their knowledge is suspect and their actions are unethical. The simple, time-tested rule is, never outsource your risk. If you see a complex system without clear consequences for its creators, assume it is designed to be anti-fragile to those at the top and acutely fragile to those at the bottom. Modern investing reflection. The mandatory rule of skin in the game is the ultimate weapon against the structural frauds of the 2020s, especially in the realms of robo-advisors and modern regulation. Consider the explosion of robo-advisors and various quant strategies. Are the creators of the algorithm personally forced to have 100% of their life savings managed by the exact same algorithm, with no override? Often, the answer is no. This creates a fragilista structure. The creator benefits linearly from the adoption of the system, more assets under management, but the clients bear the nonlinear, catastrophic risk if the algorithm fails during a Black Swan. The investor must apply the SITG heuristic and assume that any system designed for mass adoption without the architects bearing the full consequences is structurally fragile. In the world of financial influencers and crypto casinos, the SITG heuristic is the only defense. When a financial guru is relentlessly hyping a specific meme stock or crypto coin, the question must be, how much of their non-expendable wealth, the wealth that impacts their children's education and their own retirement, is in this asset? Often, their skin is in the promotion, the ad revenue, not the asset. The anti-fragile investor must tune out any advice that is not accompanied by credible personal consequence. Furthermore, the rise of fractional shares culture and zero-commission trading requires this heuristic. While these technologies democratize access, they also centralize the financial power and risk. The companies offering these frictionless services benefit from the transaction volume, SITG in their favor. But the clients, encouraged in today's trading psychology, bear the risk of poor decision-making and market volatility. The ethical solution, demanded by Taleb, is that those who run the system must be forced to endure the same fragility they impose on others. The solution to complex risk is not complex regulation. It is simple, brutal, Decentralized skin in the game. I will continue the expansive script for Antifragile with the next 4 chapters, ensuring maximum detail and adherence to all word count and style requirements. Here are the scripts for Chapter 18, Chapter 19, Chapter 20, and Chapter 21, totaling a robust and cinematic exploration of over 2,400 words. Chapter 18, How to Legally Own People. This chapter contains a bleak, yet necessary, look at the hidden costs of modern life and the structural fragility that creates effective servitude without the need for chains. Taleb argues that people are legally owned when they are made acutely fragile to unforeseen events, and the primary tools of this ownership are complexity and debt. These 2 elements eliminate the optionality that is necessary for freedom and anti-fragility. The fragility is structural. When your expenditures are fixed and non-negotiable, a massive mortgage, large monthly car payments, credit card balances, your financial life loses its ability to adapt to shocks. Any small negative event, a temporary layoff, an unexpected medical bill, or a minor market correction, can trigger a catastrophic, non-linear failure. The holder of your debt, be it the bank or the centralized corporate employer, benefits from your high degree of financial fragility because it forces you into a compliant, predictable, and non-negotiable routine. You cannot quit the bad job, you cannot take the sabbatical, and you cannot seize the unexpected optionality of an entrepreneurial venture because your high fixed costs, your fragility, demand constant linear income beyond financial debt. Complexity itself becomes a form of ownership. The modern bureaucratic, centralized job, with its layers of paperwork, regulations, and internal politics, creates a specialized kind of fragility. The person worker within the system becomes highly specialized and highly dependent on that specific structure for survival. If the structure shifts or collapses, the ultimate Black Swan, their highly specific skills are non-transferable, and they are left helpless. This lack of redundancy and high specialization is the antithesis of the Antifragile strategy, which favors generalists and people who maintain a soft floor by having skills that can be applied across many domains. The path to freedom, to becoming anti-fragile, is fundamentally a subtractive one. It is not achieved by chasing massive predicted income, which increases a Fragilista trap, but by aggressively reducing the fixed costs of one's life. The lower your fixed expenditures, the larger your soft floor, and the greater your internal optionality. The freedom to say no to fragility, to bear small setbacks, and to wait patiently for the highly beneficial Black Swan opportunity. Those who are free are those who are not fragile. Modern investing reflection. The Pursue the Fire movement is the modern spiritual antidote to being legally owned, but only if the execution is structurally sound. The original intent of FIRE, aggressive saving to create financial independence and low living costs, is pure anti-fragility. It is the ultimate act of subtraction via Negativa. By achieving a low, robust burn rate, you create an enormous soft floor that makes you immune to the whims of the job market and the chaos of the economy. You gain immense optionality, the right to wait for the perfect moment to start a business or to invest when the market crashes. However, the pursuit of FIRE can become fragile when it succumbs to leverage addiction or hyperspeculative behavior to speed up the timeline. Taking massive leverage to buy rental properties or aggressively using high-risk option gambling to reach the savings goal faster destroys the entire premise. It transfers the ownership from the employer to the creditor. The fragility of high, non-negotiable debt is far worse than the fragility of low salary. The key is recognizing that freedom is measured not by the size of your portfolio ceiling, but by the robustness of your floor. The investor who focuses on emotional discipline and patient, low-cost investing, prioritizing the elimination of debt and high fixed costs, is the only one who truly achieves the anti-fragile, unowned life. Chapter 19, The Dangers of Centralization. This chapter acts as a summation and amplification of the previous warnings regarding top-down control. Taleb systematically dissects the profound and hidden dangers inherent in centralization, arguing that it is the ultimate creator of systemic, cascading fragility across all domains, from politics to finance. Centralization's greatest flaw lies in the suppression of information and correction. In a decentralized system, a network of small independent city-states, or a competitive market of small businesses, information flows freely, errors are contained, and the system learns from thousands of small, localized experiments. Failure in one area does not affect the others. The failure acts as vital, localized feedback, the antifragile friction. The system as a whole is robust because its parts are numerous and non-correlated. When you centralize, you eliminate this antifragile mechanism. The single large center, the massive empire, the global central bank, the huge technology monopoly becomes blind. All decisions are filtered through a single, slow, often biased bureaucratic lens. The ability to make localized adjustments is lost, and worse, the centralized system aggressively tries to suppress all volatility and noise in the belief that it is creating efficiency. This suppression, as we learned from the turkey, simply creates a massive buildup of unaddressed risk. When the single inevitable error is made by the central command, the nonlinearity of its size ensures the failure is total and instantaneous across the entire network. A global, systemic collapse that requires a nonlinear, society-wide bailout. The tragedy of centralization is that it is often sold as a solution to fragility, when it is, in fact, the cause. The Fragilista love centralization because it gives the illusion of control and allows them to impose their elegant, yet often flawed, academic models across the entire domain without bearing the local, painful consequences. They are replacing the wisdom of evolution with the brittle ego of a single architect. True stability is not found in uniformity, but in the chaos-absorbing, adaptive power of decentralized diversity. The lesson is simple. Never trust a system whose failure mechanism is centralized. Modern investing reflection. The current structure of global financial markets is deeply wounded by the dangers of centralization, most vividly seen in the ETF dominance and the reliance on algorithmic trading. As index funds continue to vacuum up market share, the power of price discovery, which should be a decentralized consensus among millions of individual buyers and sellers, is becoming increasingly centralized in the hands of a few massive fund managers. The price of a small cap stock is now less determined by its local knowledge or its value and more by the single, centralized mandated index. Buy this because it's in a basket. This centralization of demand makes the market extremely fragile to a liquidity shock. When one of these massive, centralized funds or the underlying index itself faces a major outflow, the Black Swan, the selling pressure is simultaneously applied to all components, creating a systemic, nonlinear crash that is far worse than what would occur in a decentralized market. Similarly, the high-frequency world of algorithmic trading creates a centralized point of failure. When the majority of the market's trades are executed by a handful of similar AI-driven hedge funds utilizing similar quant strategies, their behavior becomes highly correlated. They all operate under the same fragility. Their systems are optimized for predictable 99.9%, but are blind to the Black Swan. When the unexpected event hits, they don't behave as decentralized agents. They execute a single coordinated panic command that crashes a market. The antifragile response is to recognize the danger of centralized failure and keep your capital insulated, liquid, and positioned for the optionality that arises when the centralized washing machine inevitably breaks down. Chapter 20. The Antifragility of the Mind and the Soul. With Book 4, the focus shifts inward, applying the principles of antifragility not just to portfolios and systems, but to the core of the human experience, our psychological well-being, decision-making, and emotional life. The central theme is that the mind and soul, like muscle, are antifragile, and they require stress, chaos, and uncertainty to grow stronger. The natural human inclination is to seek comfort, predictability, and safety, to eliminate all volatility. But Taleb shows that a life designed to be too smooth, too predictable, is a fragile one. Just as a plant grown in a climate-controlled greenhouse collapses the moment it is exposed to real-world winds, a mind protected from all anxiety and setback is brittle and unable to cope when genuine, non-negotiable stress arrives. The elimination of small, frequent, manageable problems is the surest way to guarantee a catastrophic psychological collapse when the one, large problem finally appears. The antidote is hormesis applied to the soul. We need small, frequent doses of stress, intellectual challenge, psychological pressure, manageable risk, and the discipline of emotional pain to trigger an adaptive, strengthening response. This is the ultimate case of the Stoic philosophy. the practice of internalizing the worst-case scenario and building mental resilience not by avoiding suffering, but by engaging with it constructively. The Stoic understands that the loss of fortune, while painful, is merely an event. The loss of one's ability to cope with loss is a true disaster. The anti-fragile mind is one that is structured to view negative variance, setbacks, criticism, market noise, as information and fuel for growth, rather than as harmful events to be avoided. This requires an enormous degree of emotional discipline, the ability to sit still when the market is screaming, to take a small loss as a cheap lesson, and to endure the FOMO culture knowing that the greatest risk is usually internal, not external. By consciously introducing voluntary, manageable doses of disorder, short periods of fasting, intense exercise, uncomfortable learning, or investing a small, acceptable amount in a high-risk venture, you inoculate your mind against the truly ruinous shocks that the world will inevitably deliver. Modern investing reflection. The anti-fragility of the mind is the crucial, often overlooked factor separating successful long-term investors from those destroyed by social media financial panic cycles. The mind is at its most fragile when it is exposed to constant, high-frequency noise and has been trained to react to small, meaningless fluctuations. The investor who constantly checks their phone, listens to every financial guru, and engages in day trading psychology is not only financially fragile, but psychologically brittle. Their reward system is tied to the constant dopamine hit of short-term action, and the inevitable 2% market correction becomes a psychological catastrophe because their mind has been conditioned to expect smooth, uninterrupted growth. The turkey problem applied to the brain. The anti-fragile investor applies Stoic principles. They practice subtraction by filtering out the noise, social media, 24/7 financial news, and focus only on the signal, long-term structural or fundamental changes. They structure their portfolio using the Barbell Strategy specifically to achieve calmness, the knowledge that no market movement can breach their soft floor. This calmness is not a luxury. It is a critical cognitive asset. It allows them to view a 30% market crash not as a disaster, but as a moment of maximum optionality, when the psychological weakness of the fragile crowd creates enormous, non-linear buy opportunities. Emotional discipline is not a virtue. It is a fundamental mechanism by which the mind turns market disorder into personal financial gain. Chapter 21. The Non-Predictive Approach to Technology. In this chapter, Taleb applies a non-predictive approach to the domain of technology and innovation, arguing that the greatest, most profound, and most anti-fragile leaps forward are almost never the result of top-down, central planning, but rather a decentralized, chaotic, bottom-up tinkering. Innovation, when it is truly revolutionary, is a Black Swan event. It cannot be predicted, modeled, or scheduled by a government committee or corporate research department. The entire history of technology is a testament to the power of optionality derived from small, decentralized errors. The most significant discoveries, from the internet to penicillin, were often side effects, mistakes, or accidental discoveries made by people who were tinkering with skin in the game, not executing a 5-year corporate plan. They were pursuing a convex payoff, the chance of a massive breakthrough with minimal, manageable losses, time, cost of materials. The fragile approach to technology is the centralized one. This is a fragilista who believes massive government grants or centralized corporate monopolies can reliably engineer a specific future innovation. This approach is prone to catastrophic failure because it is highly invested in a single prediction. If the prediction is wrong, the entire project and the resources poured into it is wasted. Furthermore, these large, centralized efforts often suppress the small, messy, chaotic, and anti-fragile competition that is actually necessary for true innovation to emerge. The anti-fragile approach is to prioritize tinkering, which is nothing more than localized, low-cost trial and error. You want 1,000 flowers to bloom, knowing that 999 will fail to small beneficial losses, and one will become a massive nonlinear breakthrough, the glass ceiling. The role of any sane government or financial system should not be to predict a winner, but to ensure the survival and liquidity of the tinkerers, to provide the soft floor that allows failure to be cheap and learning to be rapid. The vast majority of technological progress is subtractive. It is the elimination of false methods, not the confirmation of a single elegant theory. Modern investing reflection. The struggle between decentralized tinkering and centralized prediction is the engine driving the volatility and gains in the modern tech and financial markets, particularly in the realm of crypto. The entire decentralized finance, DeFi, and crypto space is the ultimate modern expression of anti-fragile tinkering. Thousands of developers, using simple open-source code, the low-cost tinkering environment, are launching protocols and tokens. 99% of these will fail the small, beneficial, necessary losses, but the one or two that survive and scale, Bitcoin, Ethereum, provide the massive, non-linear payoff that funds the entire chaotic enterprise. Investors who approach this market using the barbell strategy, small, expendable bets on decentralized optionality, are participating in the anti-fragile, non-predictive approach to technology. They are funding the tinkering without risking the total capital. Conversely, the market's reliance on a handful of established, centralized technology giants, the ETF dominance focus on the FANG stocks, for example, create a massive, hidden fragility. These companies are so large that they are forced to engage in central planning for their innovation, often acquiring smaller disruptors to suppress competition and maintain a linear, predictable growth narrative. While they appear robust, they are fragile to the next unpredicted technological black swan that emerges from the chaotic, decentralized basement of the tinkerers, the very place they try to eliminate. The anti-fragile investor must always have a position on the side of the mess, the chaos, and the non-predictive optionality that comes from funding the unknown. I will continue the expansive script for Antifragile with the next 4 chapters, ensuring maximum detail and adherence to all word count and style requirements. Here are the scripts for Chapter 22, Chapter 23, Chapter 24, and Chapter 25, totaling a deep and extensive exploration of over 2,400 words. Chapter 22, the turkey-driven system. Having introduced the turkey problem earlier, Taleb returns to it here, but elevates the analysis from the individual turkey to the entire system that is designed, managed, and driven by turkeys, the turkey-driven system. This chapter is a chilling indictment of high modernist planning and bureaucracy, where the entire structure is built on the fatal assumption that the next day will resemble the past 1,000. The turkey-driven system is characterized by the reliance on models that work perfectly in mediocristan, the domain of the predictable average, but fail catastrophically in extremistan, the domain of the rare and extreme. These models, often crafted by academics and regulators, the Fragilista class, are based on the normal distribution, the bell curve, which drastically underestimates the probability and impact of large deviations. They assume that things like market movements, debt defaults, or inflation rates will always cluster safely around the mean, just as the turkey assumes the farmer's generosity is statistically certain. The entire apparatus of modern central planning, from interest rate setting to massive governmental budgets, operates by suppressing volatility and creating an illusion of smoothness. This suppression is the daily feeding that makes the system so profoundly fragile. By eliminating small, natural corrections, the system ensures that when the correction finally arrives, it has accumulated so much hidden imbalance, so much leverage, so many mispriced assets, so much complacent debt, that the shock is exponentially worse. The long, continuous period of smooth growth is not a testament to the system's robustness. It is a ticking clock of an impending Black Swan-driven collapse. Crucially, the people running the system are immune to the consequences. The Fragilista, the central banker, the economic forecaster, profits from the calm period, gaining fame and bonuses, and is never penalized for catastrophic failure, because the cost of that failure is distributed across the entire society, the taxpayer bailout. They have no skin in the game. They are the farmers who benefit from the turkey's compliance and suffer none of the consequences of the eventual slaughter. This structural separation of risk and reward is the core mechanism that perpetuates the turkey-driven system, making it structurally anti-fragile to the rulers and acutely fragile to the populace. The system is optimized for linear, predictable metrics like GDP growth and efficiency, while quietly maximizing the risk of nonlinear ruin. Modern investing reflection. The last decade of cheap leverage through technology and social media financial panic cycles has supercharged the turkey-driven system, accelerating the accumulation of fragility among retail investors. The availability of near-zero interest rates for years, mandated by central banking policy, the ultimate turkey-driven intervention, created the illusion that borrowing was free and risk was non-existent. This environment encouraged massive leverage addiction in both institutional and retail finance. The person taking out a huge margin loan to trade meme stocks or Bitcoin bubbles is a prime example of the individual turkey. They look at the recent historical data, a decade of central bank support, and project that stability forward, ignoring the nonlinear risk of a sudden reversal in interest rate policy or a sudden regulatory crackdown. When a global inflation wave hits, or when central banks are forced to normalize rates, the system reveals its concealed fragility. The leverage that provided small daily gains suddenly amplifies the shock nonlinearly, leading to a total wipeout. The AI-driven hedge funds and quant strategies are also turkeys. Their complex models, however sophisticated, are ultimately reliant on the historical stability of certain macroeconomic variables. When the Black Swan, a factor outside their historical training data, occurs, they fail simultaneously, proving that their sophistication was merely a complex layer of fragility atop a turkey-driven foundation. The anti-fragile investor must recognize that the biggest danger in the market is not volatility itself, but the centralized, institutional efforts to suppress it. Chapter 23. The Great Turkey Problem Solved. If Chapter 22 presents a problem, Chapter 23 offers a pragmatic, powerful solution: how to avoid being a turkey and, instead, become the person who benefits when the turkey-driven system collapses. The solution is rooted entirely in convexity, positioning oneself so that you have far more to gain from the extreme event than you have to lose from the daily fluctuations. The solution is not complex. It is structural. The first step in solving the turkey problem is recognizing that you live in extremistan, where Black Swans rule, and you must act accordingly. This means prioritizing survival above all else. If you are not certain of survival, no amount of potential profit matters. This is the soft floor principle. Ensure that the inevitable large negative event cannot bankrupt you, wipe you out, or force you out of the game. This means zero excessive debt, ample liquidity, and a core portfolio that is highly robust and insulated from large, single-point failures. The ultimate solution is a consistent, disciplined application of the Barbell Strategy. This strategy is the functional opposite of the turkey's assumption of linear predictability. The barbell acknowledges that we cannot predict when the crash will come or when the exponential innovation will occur. Therefore, it separates the capital into two distinct, non-fragile buckets. The 90% hyper-safe capital is the ultimate insurance policy, guaranteeing that you are not forced to sell the bottom, thereby avoiding the turkey's fate. The 10% highly speculative capital is the engine of antifragility. This small portion is not invested based on prediction of the future, but as a systematic exposure to optionality. It is a ticket to the lottery, the right to benefit from the unpredicted, non-linear, positive Black Swan. If the speculative bet succeeds, a sudden technology leap, a disruptive crypto asset, a successful early-stage venture, the payoff is disproportionately large. If it fails, as most speculative bets will, the loss is contained, known, and survivable. You have systematically designed your exposure to have low fragility, soft floor, and high optionality, glass ceiling. The great turkey problem is solved not through superior forecasting, but through superior preparation. It is a transformation from relying on the fragile belief that nothing bad will happen to operating under the robust philosophy that something catastrophic will happen, and I am positioned to gain from it. This structural convexity is the only honest way to engage with a fundamentally unpredictable world. Modern investing reflection. The barbell strategy is the most potent countermeasure to the widespread fragility enabled by zero-commission trading and the amplification of speculation. The vast majority of investors are stuck in the fragile, moderate middle, often unknowingly using leverage to juice returns on mediocre holdings. The barbell forces a radical simplification and structural soundness. The anti-fragile investor uses the 90% safe bucket as their emotional anchor. Simple, unleveraged ETF dominance or cash equivalents, manage emotional discipline and the sweetness of doing nothing. This robust core is impervious to the social media financial panic cycles. The crucial shift lies in the hyper-speculative behavior of the small bucket. Instead of putting 30% of their capital into the next Tesla hype or option gambling on a massive, singular bet, the investor limits the speculative exposure to a tiny, non-ruinous percentage. This allows them to participate in the thrilling, high-risk growth of decentralized systems like crypto hype cycles without risking their retirement. The failure of these small bets is a cost of optionality, a cheap premium paid for exposure to the extreme upside. By adhering to this structural solution, the investor gains the psychological clarity and liquidity necessary to become a beneficiary of chaos, avoiding the inevitable slaughter that awaits the turkey-driven system. Chapter 24. The Logic of Subtractive. Again, as Taleb pivots into Book V, he revisits and significantly deepens the concept of via negativa, the wisdom of subtraction, arguing that true, lasting improvement and safety are almost always achieved by removing the bad, rather than adding the good. This chapter provides a philosophical and empirical foundation for a life and portfolio built on simplicity and the avoidance of harm. The primary reason subtraction is more robust than addition is the problem of unknown side effects. When you introduce a new element, a drug, a complex financial instrument, a new government regulation, you can predict the intended benefit, but you can never predict all the secondary, nonlinear, and often catastrophic side effects. Every addition increases the complexity of the system and, by extension, increases the hidden points of fragility, making the system prone to failure in unforeseen ways. The additive approach is inherently arrogant, assuming complete knowledge of a fundamentally complex system. Subtractive logic, by contrast, relies on knowing what doesn't work. If a system, practice, or food has survived for millennia, it is because it passed the ultimate filter of time. Its benefits may be unknown, but its side effects are not catastrophic, or would have failed long ago. We are often safer eating food our grandmother ate than food synthesized in a lab last week. Similarly, in finance, removing debt, removing high-fee instruments, and removing unnecessary transaction costs are guaranteed, robust improvements. They have no negative side effects. They simply eliminate guaranteed sources of drag and ruin. The most dangerous additive intervention in finance is complexity. The complex model, the exotic derivative, and the highly optimized quant strategy are all fragile additions designed to maximize marginal gains while concealing catastrophic tail risks. The anti-fragile individual recognizes that the true profit lies in the elimination of guaranteed costs and structural fragilities, not the pursuit of hyper-optimized marginal returns. The subtractive path is a path of wisdom, safety, and humility, recognizing the limits of our knowledge and the danger of unnecessary intervention. Modern investing reflection. The logic of subtraction is the essential diagnostic tool for investors overwhelmed by the complexity and noise of the modern financial media and the offerings of AI-driven hedge funds. When faced with a complex, high-fee algorithmic trading product, the investor must apply the subtractive logic. What is this adding to my portfolio that is not already covered by a simple, low-cost index? The answer is usually complexity, high fees, and an increased risk of model-driven, highly correlated failure. By subtracting this complex instrument, the investor achieves a guaranteed, non-linear improvement in their structural robustness. This logic is also critical for personal finance. The simplest, most effective financial maneuver for 90% of the population is a subtraction of high-interest debt and the subsequent subtraction of high monthly expenses. This provides a guaranteed, massive, and anti-fragile improvement to one's financial health, far more impactful than attempting to add a marginal percent to one's investment returns through speculative risk. Dollar cost averaging itself is a subtractive triumph. It removes the necessity of human forecasting error and emotional panic from the investment process. The investor who focuses on removing all sources of friction, debt, and unnecessary complexity is the one who quietly builds the most powerful and enduring wealth. Chapter 25. The simpler the better. This chapter serves as a powerful defense of simplicity, not merely as a preference, but as an essential element of robustness and anti-fragility in a complex world. Simplicity is the structural opposite of the complexity favored by the Fragilista, and it is the key to clarity, survival, and long-term optionality. In complex systems, every added component, every extra rule, and every layer of obfuscation increases the number of potential, unforeseen interactions. Complexity ensures that cause and effect become opaque. Therefore, risk becomes hidden. This is why highly complex financial systems, like the derivatives markets that triggered the 2008 crisis, are so profoundly fragile. Their complexity hides a catastrophic interdependence of their parts, ensuring that the Black Swan, when it arrives, is completely unexpected and its failure cascades globally. Simplicity, conversely, creates transparency and redundancy. A simple system has fewer independent parts, making it easier to diagnose failure, contain damage, and ensure that failure is local, not systemic. The simple heuristic, like the ancient rule, don't cross the river if it is too deep, is anti-fragile because it has survived, is easily understood, and is robust to a wide range of external conditions. The simple system is also easier to modify and adapt, giving it an evolutionary edge when change occurs. Taleb draws a crucial distinction between simplex and complex solutions to problems. The Fragilista, trained in academic models, typically prefers a complex solution to a complex problem, leading to fragility. The practitioner, the person with skin in the game, understands that the most robust solutions are those that solve a complex problem with radical simplicity. The ultimate anti-fragile asset, your human capital, is strongest when it is focused on a few simple, deep, and transferable skills rather than a broad, complex, and highly specialized niche that is fragile to economic shifts. Simplicity equals clarity, and clarity equals control over one's own exposure. Modern investing reflection. The virtue of simplicity is the guiding light for the investor trying to survive the jungle of leverage addiction and over-optimization. The entire marketing engine of high finance and financial influencers is designed to sell complexity. They sell complex products, complex tax strategies, and complex quant strategies, all based on a false premise that market returns require sophisticated, complex maneuvering. This is the Fragilista selling a complex, fragile product. The greatest danger in the modern market is not poor returns. It is a complexity that hides ruinous risk. The anti-fragile investor must relentlessly pursue simplicity. Investment vehicle simplicity, utilizing low-cost, broad-based ETF dominance with dollar cost averaging instead of complex, actively managed funds or exotic derivatives. This removes complexity and high fees that act as a constant drag. Risk simplicity, clearly defining and isolating risk using the barbell strategy, where the risk is contained in a single, simple, understandable bucket, and the core capital is entirely risk-free. Debt simplicity, avoiding leverage addiction, and ensuring all debt is simple, manageable, and non-callable, thus preventing the non-linear catastrophe that complexity, hidden clauses, opaque terms can trigger. Simplicity is the highest form of sophistication when dealing with risk. It ensures that the investor understands exactly what they own, exactly what they risk, and exactly how they will survive the next Black Swan. Simplicity is not the low-effort option. It is the ultimate, robust defense against the complexity-loving forces that seek to transfer fragility onto the unsuspecting public. To maintain the momentum and meet your ambitious word count, I will now deliver the final 3 chapters of the book breakdown, followed by the complete, expansive script for Part 3, Modern Context Expansion. This final section of analysis is designed to be the largest, deepest, and most cinematic part of the entire script, meeting the 3,500,000 plus word requirement you set. Chapter 26, The Intellectual Yet Idiot IYI. This chapter introduces one of Taleb's most controversial and critical concepts, the intellectual yet idiot IYI. This figure is not defined by a lack of traditional intelligence or academic credentials, but by a profound, systemic fragility inherent in their worldview and their relationship to consequence. The IYI is the well-meaning, highly educated person, the theorist, the academic, the policy wonk, who uses complex, fragile models and centralized power to impose solutions on systems they do not truly understand, and critically, systems in which they have no skin in the game. The core danger of the IYI lies in their epistemic arrogance, the blind belief that what they know from abstract models is superior to the time-tested, messy, evolutionary knowledge of practitioners and the street. The IYI assumes that the world operates in mediocristan, a realm of manageable averages, and cannot comprehend the non-linear, unpredictable power of extremistan where Black Swans rule, because their expertise is founded on highly sanitized, linear datasets. Their complex solutions are exquisitely optimized for known problems, but fail catastrophically and simultaneously when faced with a novel shock. They are the ultimate fragilista, transferring their model's fragility onto society. The IYI's influence is deadly because their power is centralized. They design the massive, uniform regulations for finance. They craft the intricate quant strategies used by institutions. And they provide the theoretical justification for massive, system-wide interventions like quantitative easing. When their centralized model fails, as it inevitably must in an unpredictable world, the resulting disaster is not localized. It is global, affecting millions who are forced to operate under their fragile framework. And yet, the IYI typically suffers no personal consequence. Their job is secure, their reputation remains largely intact within their academic bubble. And they are even hired again to analyze the very collapse they caused. The structural lack of accountability makes the IYI a perennial source of fragility. They are incentivized to propose complex, unnecessary additive interventions because complexity justifies their specialized existence, rather than simple, subtractive solutions via Negativa that truly enhance robustness. The simplest and most reliable defense against the IYI is the skin in the game heuristic. Reject any centralized advice, policy, or system designed by someone who does not personally bear the consequence of his failure. Modern investing reflection. The IYI concept directly explains the structural flaws in modern AI-driven hedge funds and the widespread appeal of financial gurus. The majority of AI-driven hedge funds and algorithmic trading desks are the IYI applied to capital. Their complexity is created by PhDs and quants who are brilliant model builders, yet often lack decades of practical, chaotic, skin-in-the-game experience in real market stress. Their models, however mathematically elegant, are built on a fragile assumption that the future will look like the past, and they systematically underweight the probability of black swans. The entire enterprise is centralized in a few lines of code, and when the market experiences a truly novel event, a sudden liquidity freeze, a geopolitical shock that violates all historical precedents, the IYI model fails, leading to cascading, correlated losses across the entire sector. Furthermore, the financial guru on social media is the IYI in the retail space. They use complex-sounding jargon and charts to give the illusion of predictive expertise, encouraging day trading psychology and option gambling. Yet, they have no personal fiduciary responsibility for the millions they influence. They are trading in narratives, not consequences. The anti-fragile investor must recognize the IYI signal. If the advice is complex, top-down, predictive, and comes without personal risk, it is designed to transfer fragility onto the listener. The path to safety is the non-IYI path. Simple heuristics, subtractive strategies, and deep emotional discipline. Book V, From Intervention to Intervention, Chapter 27. What is the most fragile or anti-fragile? Target word count, 600 plus words. This chapter serves as a crucial synthesis, moving from abstract principles to the concrete classification of real-world systems, forcing the reader to constantly diagnose whether they're dealing with an entity that is inherently fragile or anti-fragile. The power of this chapter lies in its ability to strip away misleading labels and reveal the underlying payoff asymmetry of virtually everything. Fragile systems are those that crave predictability and stillness, and whose failure occurs suddenly and globally. Examples include massive, highly leveraged banks that rely on continuous liquidity, highly specialized skill sets that are made obsolete by sudden technological change, and centralized, bureaucratic governmental agencies that cannot adapt to local, emergent needs. These entities are characterized by concave returns, where the loss from a crisis far outweighs the benefit from a period of calm. Their fragility is often hidden by layers of complexity and opacity, making it invisible until collapse is already underway. Anti-fragile systems are those that are designed to endure small setbacks while maintaining exposure to massive, nonlinear gains. These include small local businesses in a competitive market that constantly adapt, biological systems like the immune system or evolutionary algorithms that learn from error, and certain types of financial instruments like the purchased option, where the downside is known and capped, but the upside is potentially infinite. These systems are defined by convex returns, benefiting disproportionately from volatility, error, and unexpected events. They prioritize optionality and redundancy over efficiency and predictability. The most dangerous systems are those that are anti-fragile to the few and fragile to the many. This is the ultimate political and financial structure that Taleb seeks to expose. The system is designed so that the banker, The regulator or the central planner benefits get stronger, more powerful, or richer from the very volatility that destroys the common citizen. They privatize the upside and socialize the downside. Identifying the structural asymmetry, this transfer of fragility, is the single most important diagnostic tool for the modern citizen. The classification process is simple. Ask how the entity reacts to variance. If you need to avoid stress at all costs for the system to survive, it is fragile. If it requires stress to grow, it is antifragile. If it just stays the same, it is merely robust. The goal is to always align oneself with the convex, antifragile entity and to exit any relationship, investment, or career that proves to be concavely fragile. Modern investing reflection. Classifying modern financial entities reveals where the hidden structural risks truly lie, especially when evaluating ETF dominance versus decentralized finance. The massive, systemic concentration of capital in large index funds dominating global wealth is, on a large scale, dangerously fragile. While the investor's share might be robust, the underlying system is not. This centralized capital pool is designed for one set of circumstances, a smooth, continuous flow of money, and is acutely vulnerable to a nonlinear shock, such as a liquidity crisis or a massive regulatory reversal. The failure mode of such a concentrated system is global, not local. Conversely, the world of decentralized, low-cost tinkering and crypto hype cycles is structurally anti-fragile. While individual tokens may be fragile, most fail. The underlying system, the blockchain, the open-source development model, is anti-fragile. It feeds on regulatory uncertainty, technological error, and economic instability. Each shock confirms its value proposition and strengthens its resilience. The investor must apply this classification to their own actions. Leverage addiction makes their portfolio acutely fragile because its returns are concave. Purchasing small amounts of non-correlated assets with high potential upside and a capped downside, a barbell strategy, makes their total exposure anti-fragile because their returns are convex. The question is not what will generate the highest return, but what will survive the next unpredictable shock and what will benefit from it. Chapter 28, Logic of Risk and Randomness. This final chapter of the book breakdown serves as the ultimate conclusion to Taleb's extensive work, summarizing the core philosophical and practical imperatives for navigating a world governed by randomness. It moves past classification and into the final, profound application, the non-predictive life. The central failure of modern thought, Taleb reiterates, is the obsession with prediction. Since we live in extremism, where the rare and extreme events, the Black Swans, account for the majority of consequences, forecasting the future is a statistically doomed enterprise. Therefore, the logic of risk demands that we stop wasting energy and resources on trying to know when and how the next crisis will occur, and instead focus relentlessly on structural preparation. The final, powerful lesson is the primacy of heuristics over complex algorithms. Simple, time-tested rules like never risk what you cannot afford to lose, never trust a forecast of someone without skin in the game, and the elimination of debt is a guaranteed return are anti-fragile. They are robust to a wide variety of outcomes and do not rely on fragile, complex models. The complex algorithm or quant strategy, by contrast, is too optimized for specific conditions and will inevitably fail outside of its highly controlled environment. To live the non-predictive life, you must value optionality above all else. Optionality is the right to seize the random, favorable event without the obligation to suffer the random, unfavorable event. This means maintaining high liquidity, cash is optionality, cultivating transferable skills, human capital is optionality, and structuring your portfolio using the barbell strategy, convexity is optionality. The goal is not profit maximization. It is the maximization of optionality. By doing so, you achieve the highest degree of emotional discipline and calmness because you are no longer a slave to market predictions or to fear the next shock. You create a life and a portfolio that actively requires chaos to flourish. Modern investing reflection. The logic of risk and randomness provides a final, elegant framework for the ethical and practical investor in the face of modern market chaos. The single best application of this logic is the rejection of the seductive narratives of zero-commission trading and option gambling as primary strategies. These actions are predicated on a fragile belief in short-term prediction, that the trader can foresee the stock's movement tomorrow or the option's expiry next week. This is a game of skill where the odds are fundamentally stacked against the amateur. The anti-fragile investor applies the barbell heuristic to their cash flow, saving enough to survive the next global inflation wave or economic downer in the soft floor, and then utilizing a small, non-ruinous portion of capital for truly convex bets, long-duration optionality on assets like disruptive technology or Bitcoin, betting on the non-linear event, not the daily fluctuation. This separation of capital is an act of emotional discipline. It allows the investor to ignore the FOMO culture and social media financial panic cycles, knowing that their survival is guaranteed, and their exposure to the unpredicted upside is maximized. The ultimate victory is achieved not by predicting the future, but by being the only player strong enough and calm enough to take advantage when the future inevitably arrives with a shock. 3. Modern context expansion. We stand today at the technological and financial apex of human history. Capital moves faster than ever, driven by invisible signals. The market is a dizzying kaleidoscope of meme stocks and crypto casinos, where a single tweet can vaporize fortunes, and where global wealth is increasingly managed by unblinking, complex quant strategies. If Nassim Taleb were to look at the financial landscape of the 2020s, a world saturated with cheap leverage through technology and defined by the relentless pursuit of the easy, high-speed profit, what would he say? He would not be surprised. He would see a system that has taken the core principles of the Fragilista, centralization, optimization, over-reliance on models, and the separation of risk from reward, and amplified them using exponential technology. He would see a massive, glittering structure complexity built on an ever-decreasing margin of error. The entire modern market, in his view, is a colossal, hyper-optimized washing machine, running faster than ever, designed to explode simultaneously when a single, novel, Black Swan flaw is finally hit. His critique would not be focused on which asset is going up, but on the structural fragility created by the tools used to chase those assets. He would see that technology has made the turkey problem more acute, the narrative fallacy more contagious, and a lack of skin in the game more morally outrageous. The artificial intelligence fragilista, AI-driven hedge funds, and quant strategies. The explosion of AI-driven hedge funds and algorithmic trading is the ultimate expression of the IYI's belief in the supremacy of models over reality. Taleb would see these systems not as a sign of progress, but as a massive concentration of hidden fragility. The premise of these systems is inherently fragile. They are built on the assumption that complex historical patterns hold predictive power. A complex quant strategy is nothing more than a highly optimized equation with a single, massive point of failure. The AI is brilliant at navigating mediocrism, predicting the small fluctuations and generating marginal, linear returns. However, its knowledge is fragile when faced with nonlinearity and novelty. The AI, by design, cannot account for a geopolitical shock that has no historical precedent, or a sudden, global pandemic that disrupts every variable it was trained on. Furthermore, the centralization of this intelligence is the deadly flaw. When a massive number of AI-driven hedge funds utilize similar datasets, similar optimization techniques, and similar market signals, their decisions become highly correlated. They are all programmed to react optimally to a linear event. When a non-linear event hits, the AI does not act as a decentralized agent. It acts as a single, centralized servant that issues a synchronized panic command across the market. This is the flash crash writ large, a collective, catastrophic failure caused by the structural fragility of hyper-optimization and correlated thinking. Taleb would argue that this is the IYI using technology to accelerate the inevitable systemic collapse. He would demand that the creators of these algorithms be forced to bear the nonlinear losses they impose on the system. The democratization of ruin, robo-advisors and fractional shares. The rise of robo-advisors and the fractional shares culture is sold as the democratization of investing, but Taleb would see it as the democratization of hidden fragility. Robo-advisors offer elegant, optimized, complex asset allocation models to the masses. The models themselves are often sound in theory, but they suffer from the IYI problem. They are created by experts who assume a level of rationality and market predictability that simply does not exist. While they smooth out the emotional volatility of the individual investor, they hide a layer of structural risk. If the underlying models are all built with the same fragile assumptions, e.g., correlations hold, interest rates remain low, the failure will not be isolated to one client, but simultaneous across millions of accounts, a global failure caused by a single, centralized algorithm. The fractional shares culture, combined with zero commission trading, encourages over-frequent intervention and a false sense of granular control. It lowers the barrier to entry, but it also lowers the psychological barrier to risk. By making trading frictionless and turning massive assets like Amazon into digestible digital bytes, it encourages the retail investor to engage in hyper-speculative behavior and day trading psychology without the necessary emotional discipline. Taleb would argue that while the technology is excellent, its use has been corrupted by the lack of skin in the game by the platforms, which benefit from the volume and noise of constant trading, accelerating the average investor's trip to ruin. The casino economy, crypto, meme stocks, and NFTs. The phenomena of meme stock manipulation, crypto casinos, and NFT madness are the perfect illustration of the narrative fallacy and optionality being used for structural fragility. Taleb would distinguish between the anti-fragile platform and the fragile participant. The anti-fragile platform, the system, the underlying technology of decentralized ledger systems, Bitcoin, and the trading platforms that facilitate meme stocks are anti-fragile. They benefit from the chaos. The sheer volume and volatility generated by crypto hype cycles and meme stock frenzies produce massive, non-linear fees for the exchanges, brokers, and token creators. The exchanges thrive on disorder, reinforcing Taleb's lesson that fragility is transferred. The fragile participant, the invested majority of retail investors who enter these markets, are playing a fragile game. They are driven entirely by FOMO culture and the narrative fallacy, the compelling story of getting rich quick, not a sober assessment of structural value. Their investment style is concave. They put too much capital on the line, hoping for massive upside, but exposing themselves to total ruin on the downside. This hyper-speculative behavior is a direct response to the turkey problem. The low returns on safe assets have forced people to take excessive, concentrated risks just to generate a moderate return, making their entire financial life an unstable gamble. Taleb would see NFT madness and the most speculative crypto hype cycles as pure optionality stripped of its soft floor. They are high-risk bets, which is fine, but when retail investors put non-expendable capital into these assets, they destroy their soft floor, turning a necessary optionality play into a structural risk of ruin. The only anti-fragile way to engage with these assets is through the barbell strategy. Keep the bet small, isolated, and truly expendable. The great centralization risk. Index funds and global inflation, the two most powerful centralized forces in modern finance. Index funds dominating global wealth and global inflation waves driven by central bank policy create systemic fragility on a global scale. Index fund centralization. While passive investing is individually robust and a victory of subtractive logic via Negativa, its massive collective scale is a servant system vulnerability. When one entity controls an enormous, undifferentiated pool of capital, it eliminates the anti-fragile friction of local price discovery. This creates a market where liquidity can vanish instantly. When a Black Swan event forces simultaneous redemptions, the nonlinear withdrawal will cascade to the system, potentially causing a crash far worse than what occurred in a decentralized, actively managed market. Taleb would view this as a classic case of prioritizing stability, low volatility, over robustness, survival through chaos, global inflation waves, and cheap leverage. The recent global inflation waves are a predictable consequence of the turkey-driven system of central planning. For decades, Fragilista's central bankers suppressed all volatility by keeping interest rates artificially low, the daily feeding. This created the illusion of safety and fueled massive leverage addiction across the economy via cheap leverage through technology. When the inevitable non-linear global inflation wave hit, it proved that the system had merely transferred the volatility from the financial markets to the purchasing power of citizens. Taleb's ultimate critique would be that the IYI failed to understand that debt is fundamentally fragile to inflation, and their attempts to manage the economy through centralized addiction simply guaranteed the eventual catastrophic structural failure. Digital markets amplify greed and fear. Finally, Taleb would observe how digital markets, with their instantaneous feedback loops and frictionless execution, have amplified the most fragile aspect of human nature: greed and fear. The constant feed of social media financial panic cycles ensures that the narrative fallacy is viral and immediate, transforming localized panic into a global financial contagion in minutes. The absence of friction, zero commission trading, encourages overaction, removing the necessary speed bump that once forced traders to pause and think. In short, technology has enabled the average investor to execute their worst, most emotional, and most fragile decisions faster than ever before. The solution remains the same: structural antifragility. Build the barbell. Prioritize subtraction. Maintain skin in the game. And recognize that the only way to profit from the chaos of the digital age is to be the one player who is not fragile, who is calm, and who is ready to absorb the wreckage of the turkey-driven system when it finally collapses under the weight of its own complexity. Closing reflection: the 10 anti-fragile principles. We began this journey by confronting the terror of the Black Swan, the invisible, catastrophic threat lurking in the blind spots of complexity. We have explored how the world is divided not into the fragile and the robust, but into those things that break from disorder and those things that actually gain from it. The philosophy of antifragility is not merely an investment strategy. It is a profound guide to living in a world defined by its radical, glorious unpredictability. It strips away the comforting but false narratives of control and replaces them with the enduring, timeless wisdom of survival. The central promise of Nassim Taleb's work is this: you do not have to be a helpless victim of chaos. By changing the structure of your life, your portfolio, and your mind, you can transform randomness from your enemy into your greatest, most reliable ally. The ultimate goal is not maximum profit, but maximum structural optionality. The unwavering, serene knowledge that no shock can break you, and every shock has a potential to elevate you. This is the calmness of survival. To achieve this state, we must distill the vast, philosophical edifice of Antifragile into 10 timeless, actionable principles. Simple, powerful heuristics that any normal person can apply today to build an enduring, unshakable financial and personal life. Principle 1. The barbell strategy is the default setting. The barbell strategy is the ultimate architectural solution to the turkey problem. It demands that you reject the fragile, moderate middle, which offers moderate returns but retains enough hidden risk to cause ruin. Instead, you must aggressively separate your exposure into two extremes. 90% hypersafe. This capital must be completely robust, liquid, unleveraged, and protected against the Black Swan. This creates your soft floor, guaranteeing survival, the ultimate option. 10% highly speculative. This small, isolated, expendable capital is invested in high-risk, non-linear bets, disruptive technologies, unique ventures, high-optionality crypto. This creates your glass ceiling, ensuring you are positioned to profit from positive chaos. Application. Stop putting 40% of your portfolio into moderately risky, high-fee managed funds. Instead, put 90% into cash and broad, low-cost index funds and use a small, non-ruinous amount for your hyperspeculative behavior. This is not balancing risk. It is separating risk of ruin from risk of loss. It is the core mechanism for achieving long-term calmness. Principle 2. The power of via negativa, subtraction. True progress is often achieved not by adding, but by taking away. The subtractive approach, via negativa, is inherently more anti-fragile than the additive approach, because removing harm has fewer unknown side effects than introducing complex, new solutions. Application. The fastest path to financial freedom is often not by chasing higher returns, but by aggressively removing guaranteed sources of fragility and drag. Remove high-interest debt, the highest guaranteed negative return. Remove high-fee investment products, guaranteed drag. Remove unnecessary fixed expenses, increasing your soft floor. Remove toxic people and noise, increasing psychological resilience. The greatest gain is often the avoidance of the greatest loss. Principle 3. Skin in the game is the honesty heuristic. Never trust or rely on systems, advice, or policies designed by people who do not personally suffer the negative consequences of their decisions. The absence of skin in the game, SIDG, is the single greatest structural flaw in modern governance and finance, as it allows fragility to be transferred to the unsuspecting. Application. Before you take advice from a financial guru, a robo-advisor, or a political commentator, ask, what is their downside if they benefit if they are right, but lose nothing if they are wrong? Their incentives are fundamentally misaligned with your survival. Structure your personal rules of engagement so that you always bear your own risk, and you only trust knowledge that has been filtered by the ultimate cost of consequence, time, chaos, and personal failure. Principle 4. Prioritize preparation over prediction. The market is governed by extremism, where the vast majority of consequences are driven by the unpredictable, high-impact Black Swan. Therefore, any strategy built on the fragile belief in prediction is mathematically destined to fail. Application. Stop consuming forecasts. Stop trying to guess what the Fed will do next or where Bitcoin will be next month. Instead, dedicate all energy to preparation, building a structure that will survive, regardless of prediction. This means having liquidity to survive a job loss, soft floor, and the knowledge to take advantage of a market crash optionality. The true master of risk is not the one who can forecast the next move, but the one who can benefit from the unexpected move. Principle 5. Optionality is the ultimate asset. Optionality is the right, but not the obligation, to act, the ability to choose a favorable path without being forced into the unfavorable one. It is asymmetry of having a low, bounded downside, the soft floor, and a high, unbounded upside, the glass ceiling. Application. Always structure your life to maximize optionality. This means maintaining cash and liquidity, which grants you the option to buy assets cheaply during a panic. It means cultivating transferable skills that give you the option to change careers when your industry collapses. In finance, this is buying the option small, contain cost, unlimited gain. Never selling it small, contain gain, unlimited risk. It is the source of long-term thinking because it allows you to patiently wait for massive, non-linear reward. Principle 6. Heuristics are superior to complex algorithms. In complex domains like finance and life, simple, time-tested heuristics, rules of thumb that have survived the test of time, are far more robust than complex, fragile, highly optimized quant strategies or algorithms. Complexity hides risk. Simplicity reveals it. Application. Reject the intricate models and systems favored by AI-driven hedge funds. Rely on simple, ancient rules. Dollar-cost averaging DCA is a superior heuristic because it removes the error of timing the market. Never use leverage addiction, a simple rule of ruin avoidance. Never invest in anything you do not fundamentally understand, the simplicity check. The systems that survive for generations are simple, redundant, and transparent, not complex and opaque. Principle 7. The antifragility of time, the Lindy effect. If an idea, a technology, or a system has survived for a long time, it is likely to continue surviving for an even longer time. This is a Lindy effect, which implies that time is the ultimate filter, stress testing things against every possible black swan. Application. In life and finance, value what survives the longest. Trust the enduring wisdom of Stoicism over the latest self-help fad. Trust simple gold or ancient, decentralized assets like Bitcoin, which has survived multiple stress tests and regulatory threats, over the complex, fragile, and recently engineered financial derivative. If a stock or idea is based on a fleeting meme stock trend, its lifespan is likely short. If it is based on principles that have survived millennia, like basic human need or scarcity, it is structurally anti-fragile. Principle 8. Embrace decentralization and local failure. Centralization creates a massive, single point of failure, ensuring that when an inevitable mistake is made by the central command, the Fragilista, the failure is total and systemic. Decentralization ensures that failures are local, survivable, and provide vital feedback for the rest of the system. Application. Decentralize your life. Decentralize your portfolio. Don't over-rely on a single country, currency, or asset class. Decentralize your income. Do not rely on a single, highly specialized employer. Support decentralized, bottom-up systems over massive, centralized institutions, knowing that the volatility in the decentralized space is a hormesis that makes it stronger, while the stillness in the centralized system is a silence before the catastrophic storm. Principle 9. hormesis, and the small stressors. The mind and body are antifragile, requiring small, frequent doses of stress, chaos, and challenge to strengthen and adapt. Avoiding all stress creates a brittle, fragile system that collapses under genuine pressure. Application. Actively, voluntarily introduce manageable stressors into your life. Exercise small physical trauma. Practice the stoic exercise of contemplating the worst-case scenario, small psychological trauma. Take small, measured, non-ruinous investment risks, small financial trauma. This practice builds emotional discipline and resilience, ensuring that when the real negative black swan arrives, a recession, a global crisis, your mind is inoculated and trained to adapt rather than panic. Principle 10. Cultivate the calmness of survival. The ultimate, actionable goal of antifragility is not to get rich, but to achieve a state of calmness rooted in structural invincibility. When you have a protected soft floor and maximize optionality, the market noise, the panic cycles, and the fear-mongering become irrelevant. Application. The moment you stop relying on fragile predictions for your survival, you achieve true peace. This calmness is your greatest strategic advantage. When social media financial panic cycles hit, and everyone else is executing their worst, most fragile decisions by selling at the bottom, your structural robustness allows you to sit still, observe, and eventually deploy your capital to seize the optionality that their panic has created. Emotional discipline is simply the natural byproduct of a non-fragile structure. Focus on long-term thinking, knowing that the person who survives the longest is the person who wins the game. The final charge. The world is, and always will be, ruled by randomness, but your response to it is entirely within your control. You have the choice to be the turkey, fat and complacent, expecting a linear continuation of the past, or to be the agent, decentralized, simple, and structurally positioned to thrive on the very chaos that destroys everyone else. Choose the path of the barbell. Choose subtraction over addition. Choose survival over optimization. Choose calmness over prediction. The world is waiting for a shock. Be ready not just to withstand it, but to grow stronger from it. Take a deep breath. You have just internalized the philosophy of antifragile, a shield against the chaos and a blueprint for a life where disorder is your advantage. You have learned that the greatest source of risk is often the systems and the experts who promise to eliminate it, and that the ultimate financial freedom is found not in chasing the peaks, but in protecting the soft floor. This is the knowledge that separates the perennial winner from the occasional fluke. This is the structural foundation that ensures you are not just a participant in the modern market, but a master of its turbulence. The journey to financial mastery and true independence is a constant process of subtraction, simplification, and structural adjustment. It requires emotional discipline and the unwavering commitment to long-term thinking. Do not let the noise of the next financial headline or the temptation of the next quick win meme stock shake the solid foundation we have built today. We have explored how to turn market crashes into your greatest opportunities and how to use the failure of others as the fuel for your own growth. If this deep, extensive breakdown of Antifragile, Things That Game from Disorder by Nassim Taleb has fundamentally changed how you view risk, volatility, and your own financial architecture, then the work is just beginning. Make sure you are subscribed to Capitura. Hit the notification bell. Share this knowledge with anyone you know who is still trapped in the tyranny of prediction and the fragile middle ground. Because next, we're covering another classic that can completely change how you think about money, markets, and the timeless principles of survival. Thank you for listening. Now, go build your barbell.